So welcome everyone. My name's Karen Grant. I'm very pleased to welcome you to this Equation Angels education session on search funds. We will be running through a whole bunch of information. I'll talk about that in just a moment. But first, we have a number of new guests who have joined us today. And so I'm just going to take a moment and explain who Equation Angel or what Equation Angels is. Equation Angels is a joint venture between the Golden Triangle Angel Network, Angel One Network, and Southwestern Ontario Angels, which was formed a year ago. And actually, no, was formed in October. Actually, I'm losing track of it. A year and a half ago, we formed. And a year ago, we were able to welcome the Windsor Essex Capital Angel Network Angel Group to our fold. So we're 4 angel groups that have chosen to work collaboratively. And if you'll move me on to the next slide, Michelle. Together, we are over 125 check writing accredited investors. All of our members must be accredited. Into 281 investments. We run programs throughout each month, and this calendar will show to you that we have a early stage investment meeting on March the 16th, followed by a later stage investment meeting on the 17th. The Equation Angels First Look program is a collaborative effort with the Regional Innovation Centers in Ontario, and we co-host the event with one of the Regional Innovation Centers, and it will be Haltech on March the 23rd. And that will have 6 companies that will be presenting. They are at an earlier stage, more in the startup, maybe a little pre-revenue stage, and it is in fact an opportunity for our members to get a first look at these up-and-coming companies that will eventually, the ones that succeed, gain a place at the early stage investment meeting for funding with us. And then once a month, we also hold a peer-to-peer meeting, which is focused on our members and their portfolio companies, where we provide them with information in terms of funding sources, government programs, celebrating some of the successes in our portfolio. Sometimes it's cautionary tales, but it's an opportunity for our founders and their investors to get together and talk about situations in the ecosystem. And then lastly, on April the 13th, we'll be holding another educational event, this one focused on due diligence for our members that are coming into our group as first-time angel investors. Next slide, please. So I'm very pleased to welcome Carl Sidras as my co-host for today's meeting. Carl, do you want to step up and introduce yourself, please?
Certainly. Well, thank you, Karen. I serve as an advisor to entrepreneurs and executives desiring to sell their business or grow through acquisition or raise capital. I'm also a mentor to business school students and newly immigrated Canadians on their personal and professional growth, and I'm a volunteer on non-for-profit boards, which includes my role at Angel One Network.
And Carl's being modest, but he was the one who brought this whole concept to Equation about looking at search funds and learning more about it and sharing that information with our members. And so Carl and I will be hosting today's session, and we've got a number of phenomenal speakers. So I'm going to move on to that. Stay on the screen, please, Carl, and let's just introduce our speakers. As you can see, we've got a wealth of talent here. And what I've done to save time is I'm asking each of these speakers as they first speak to introduce themselves and explain their involvement in Search Fund as well as their topic. So maybe we can move on to the agenda, and then we can get right into our program. So we're very pleased to have Karen Spencer, who's going to be setting the stage for us from searchfunder.com and providing us with that introduction into search funds. And then we'll be moving on through the agenda with the rest of our speakers. So Karen will be followed by John Perko from Sage Capital, and then Mario Negro will be talking about partnerships and structures. Steve Ressler is a experienced angel and search fund investor, and will be providing a perspective of search funds from his experience. And then we're very pleased to have Dan Chetrit from Snowden Partners, who will be providing a bit of a case study on search funds and the whole life cycle of a search fund from formation to exit. So that's going to be our program. But this is such a talented group. They're going to be invited in to wade into all of these categories. So I'm hoping that we'll make this as interactive as possible and interesting viewing. Now I'll ask people to include their questions throughout the sessions in the chat. We'll be monitoring that and watching to make sure that we capture all of the questions that you may have throughout the program. And then lastly, we will be having a panel of all of our speakers where the audience will be able to really ask the questions that they have. So that's the program for this morning. It's going to be a lot. We'll try to keep it interesting. And Karen, I'm going to ask you to take over at this point and kick off the first session.
Thank you, Karen. It is an honor to be here to present. And as Karen mentioned, I am with searchfunder.com. We are an online community for the search fund ecosystem. We were founded from the idea of my two co-founders, Mark and Luke. They had a friend at Harvard Business School who was doing a search fund, and they were going to that other competing school down the street called MIT Sloan, and they realized that they could not break into the search fund ecosystem. And being good MIT grads, they decided that it was right for a platform and to be able to provide information to searchers. And ever since then, it's been off to the races. So my job today is just to provide an introduction to the search fund space. And Michelle, if you could go to the next slide, I'd appreciate it. And then the next one. And I'm just gonna give you the who, what, where, and about it. So let's start with the what. Search funds are a subset of entrepreneurship by acquisition. And until I met Mark and Luke, I didn't even know that it was really a thing. And I still hear that today as as new searchers come on board, that they're very excited to learn that they can actually have the opportunity to buy a company. Typically, what they're looking for is the kind of business that is suitable for a first time operator. It's generally profitable, generally stable, no real bugaboos. You want low customer concentration. So the who is essentially college educated, business school graduates, although there is a good chunk that have just a high school diploma. It's primarily taught at the elite schools, and that has been the center of gravity for the search fund ecosystem. Originally, it was newly minted MBAs. Now it's mid-career professionals. It's second career professionals as well. The reason why many searchers go into this is that they want the autonomy of small and medium-sized business ownership. They want leadership. They want, and increasingly, I hear more often, social impact, to be able to have an impact on the communities in which they are living. Next slide, please. And the where. Now it is truly, I can say, a global experience. We at Search Funder talk to folks from Australia to Africa to Ontario. So it's really delightful to see the progression that we've had in search funds over the last few years. In the next slide. And here is, go back just one. Yeah, thank you. So I wanted to highlight Canada. 5 years ago, it would have been just a handful of dots, and it is increasing in Canada. There's a strong level of interest, and particularly with Sage Capital coming on board, I'm sure it's increasing even more. Next slide. So various documents that you may see will have 3 or 4 different stages for search funds. I actually cribbed this slide from a searcher, and this is more from his perspective, how he felt his search went. And for most searchers, they are starting, they have to basically do a pop-up search fund, a pop-up mini private equity fund. So they've got the startup questions. It's what kind of search am I going to do? Where am I going to do it? And how I'm going to get it done? They're going to have to seek funding for their search, either, and I will explain this later, either money for the actual search itself or for the company that they're going to purchase. And of course, negotiate a deal with someone who is willing to sell to them, step in as the new CEO, and then make the best they can of the business and create genuine value for the business. Some searchers stay on their company for the remainder of their careers. Others seek exit opportunities after 5 to 7 years or so. It really depends on the searcher's preference and also the type of vehicle that they did for the launch of their search fund. Interestingly enough, most searchers become investors, and they do it rather early in their search career. I have it last on the slide, but sometimes right after they've launched their search fund, they start thinking about investing in other searchers. And then certainly once they've acquired their business and start running it, they are investing in other searchers as well. So it's a very supportive community, and there is this virtuous cycle where each searcher then becomes an investor. And so as the community grows, we have an increasing investor pool. Next slide, please. So I'm going to talk about the 2 forms of search. So there's called the traditional and the self-funded model. The traditional search model was developed at Stanford by a Harvard grad. I always like to point that out. And in 1984, he had the idea of putting advisors and mentors with a young MBA grad, and having that grad get funded to go out and buy a company, and then they would mentor the company to success and growth. So under the traditional search fund model, the investors fund the search and in return get a right of first refusal and typically a preferred return. There are IRR hurdles. There's a specific profile of company that they're looking for that they work with the searcher on developing, so they have a good understanding of what sector or areas or metrics they're going to be looking for, and then presenting as potential targets. Typically, because there is a pool of between 10, 12 investors, it's a larger deal size than the next category that I'm going to talk about, which is self-funded search. Self-funded search really began at Harvard. What the idea is that rather than taking money up front to fund the searcher funds it from their own funds. Maybe they have family money or some other way of being able to survive the 18 months to 2+ years it takes to acquire a company. And typically, the self funded searcher is using SBA loan debt in the US or family money or family office money in outside of the US. For US searchers, they may have some investors that provide additional funding on top of the SBA loan. For the searcher, there's certainly a greater financial risk, and there's certainly career risk if there is a failed search and they're not able to secure a company, or for instance, if the company is not successful and ends up having to wind down. Typically, it's, as I mentioned earlier, a smaller deal size than a traditional search investment. Next slide, please. So for our searchers, many of them look at it as whether you want to have a slice of a bigger pie as a CEO, or whether you want to own the most, if not all, of the whole pie. And that's their perspective. Next slide, please. So I spoke a little bit about the history of search, and Irv Grousbeck starting search in 1984. And from 1984 into the 2000s, it was a rather slow progression, but there have been some, huge milestones. In 1985, two Stanford grads purchased a Road Rescue. It was a towing company. That towing company, through a couple of pivots and some acquisitions, became Asurion. And if you have bought a phone, I know with my iPhone and a couple of other gadgets I've bought, I've been offered Asurion insurance. So and they are now a global entity, and it's by far one of the most successful search fund acquisitions. We've had other notable milestones, which is the first European acquisition, the first Latin American acquisition in the 2000s, and then once we got into the teens, people began to look around and think, wow, you know what? There really haven't been any women in search. And Forbes published an article, Search Funds, the boys club you've never even heard of. And up until that point, there's pretty much only one woman who had done a search, and she ended up doing a startup based off of that search, and it still runs the company today. And in 2016, we launched searchfunder.com, which is at that point is the germ or the essence of what you would see today if you started. Another milestone was in 2019, there was enough CEOs who had actually acquired companies in the search fund space for Stanford to host a CEO conference. And then last year, there was the first acquisition in Japan. Thank you. Thank you. So this is a slide from the 2020 Stanford Search Fund study, and this puts graphically what I've been saying in words about it being rather a sleepy sector until relatively recently. I would encourage you, if you are interested in search funds, to take a look at the Stanford Primer and their research studies. They provide a wealth of information about a search. Stanford has the luxury of being able to send out polls and have these detailed responses due to confidentiality from the searchers and investors. So you get a good feel for what the numbers are reading the primer. Next slide, please. So at Search Funder, we use crowdsourced data to provide statistics to our community. And this is a chart of search funds formed through 2019. So this is information reported by other searchers and searchers themselves. And if you look at the gray line at the bottom, you'll see that the development outside of the US has lagged from the US, and that's just because the elite schools in Europe really didn't come on board until relatively recently. So in many ways, the ecosystem abroad is, I would say, maybe 5 years behind where the US was and catching up. So that's search funds formed. And next slide is the acquisitions. And again, this is through 2019. We will be preparing a study for 2020 later this summer. There's a huge lag on information, so we tend to wait about 6 months before we start looking at the data for the prior year. But this is through 2019. So as you can see, acquisitions are also going up in the rest of the world. So we took a look at the data, and if you look at the average over the last 20 years or so, about 1 in 5 search funds, and that's whether they're traditional or self-funded, were outside of the US. By 2019, that gap had closed to 1 in 3. And then moreover, over the last 20 years, the average percentage of acquisitions that were closed outside of the US was about 1 in 7. By 2019, that gap had closed to just over 1 in 4. And so with that gap closing, what it's telling me is that we've got a good environment for growth in search funds outside of the US, that people are becoming much more knowledgeable, that they are becoming much more successful in being able to acquire a company. And some of the disadvantages that we thought existed outside of the US are starting to be overcome. So that was a very quick tutorial on search funds, just to provide an introduction. I'm happy to answer questions, and I'm happy for my fellow panel members to join in as well.
So that was very informative, Karen. Thank you very much. I wonder if you could comment on the other press release that happened in Canada recently with the Entrepreneurship Through Acquisition nonprofit that was recently formed in Canada.
With Beta I, yes, I thank you for spurring me on that. That is very exciting. So Beta I just made an announcement maybe a week ago. They are the first incubator accelerator for search funds in Canada, and also they are a Black entrepreneur focused search fund, and the only one in the globe. So very exciting. I'm sure it's first of hopefully many to help address structural inequities that we see around the globe related to financing and investment.
Yes, this is, I think it's, tooting the Canadian horn. We're always proud to be Canadian first with something like this. So this is great news. We've got a few questions in the chat. The first question is from Nicholas. About, is there a limit of age with search funds or the entrepreneurship through acquisition concept?
I think for entrepreneurship through acquisition, no, it's a matter of just your energy and ability to run a business. For search funds, if you were going the traditional route, typically in the U.S., it's going to be newly minted MBAs or relatively recent graduates, let's say with 3 to 7 years out. Outside of the US, there seems to be much more of an inclination towards mid-career and even second career individuals for the traditional search fund model. As a self-funded, you can do it anytime.
Great. Well, thank you.
It's Mario here. I just wanted to add something to what Karen's saying on two fronts. One, I think in Canada, the traditional searcher tends to be older, definitely older than the US, to Karen's point. I think what makes the US unique, probably in the marketplace, and subject to Karen's comments, is just the number of searchers that start directly out of an MBA program, which still, I would say, Karen, in the US is the dominant model, probably still the majority of searchers. Whereas I would say in Canada, it's the actually opposite, that the majority of searchers, frankly, a large majority of searchers have some work experience. Some people would say it's Canadian conservatism. People want to see people with more experience. I think the reality of it is there's just less capital to chase. And so you just got to be even, not enough just to have an MBA. You have to really shine even brighter. The other point I wanted to add to Karen's earlier point, what makes the search fund space particularly interesting from a diversity point of view is the ability to go a non-traditional route to be able to acquire a company. And I just think from a diversity point of view, it's super exciting, and anything we can do to encourage that. I definitely have noticed in Canada increasing diversity in the number of searchers. Still would like to see more women searchers, but what makes this space exciting, and I think will continue to make it exciting in Canada, is where the feeling is that the traditional doors may be closed. This space has the opportunity to allow entrepreneurs, regardless of their background or ethnicity or race, to be able to find new ways to raise money to buy a company and to work outside of kind of old structures that might be just inhibiting. So it's a super anything that can do to help that is super exciting.
Yes, Mario, that's right on. We've got another question here from Tom Core. How do investors get their money out? I guess Karen?
I am going to leave that to other folks. I have
Okay.
the searcher's perspective on that, and I'm sure John or Mario will be able to be much more cogent on the topic than I'm going to be.
Mario,
yeah, I mean, I can
John?
jump in. I can jump in and just give a sort of a quick answer to that, and I think that'll be addressed a little bit more throughout the session this morning. But certainly, if you're investing in search funds, it's not an income play. It's a long-term hold. The hold periods are typically somewhere between 3 to 6 years. They've come down, frankly, over the last since private equity has really taken off. The average hold period has come down probably to 3 to 5 years. We would anticipate at Sage, we kind of look at it and say it's probably a 4 to 6 year hold, possibly even 5 to 7. And so you got to be comfortable with locking up your money in a vehicle that's, very similar to, either a venture capital fund or a traditional private equity fund, is kind of how you got to look at it. And you shouldn't really expect that there's going to be dividends. Occasionally there may be, for highly successful cash flowing businesses, you may end up getting a dividend here or there, but the expectation should probably be that your money is going to be locked up for somewhere between 3 to 5 years, or probably I would anticipate longer, 4 to 6, 5 to 7. It's somewhere in that range, and it all depends really on the opportunity set for that particular company that you've acquired an interest in with your search funder.
John, this seems like a very natural segue. So let me just pause you for a moment and say, Karen, thank you so much for setting the stage for us, and also giving us that broader perspective. And as I said, this seems like a very natural segue to John Perko, who is a managing partner at Sage Capital Partners. And John, over to you.
Well, thanks, Karen. And first of all, thanks to Carl and Karen for including me in this discussion this morning. Honored to be here. And I hope to speak for less than my allotted time so that we can keep things moving here and keep the interest level up high for everyone on the line here. I'll give the sort of a brief background of myself and where I'm coming from and why I've been invited to speak on this call. So my name's John Perko. I started as a lawyer, actually. I was an M&A lawyer at Blake Castles and Graydon here in Toronto. That's where I met my co-speaker, Mario Negro, back when we were articling students and summer students at Blake. So known Mario for a long time, and then went from Blake's into traditional private equity. And I spent about 14 years at a firm called Northwater Capital in traditional private equity. Left traditional private equity and left Northwater to start my own firm called Monarch Bridge Financial. And that firm was really focused on succession planning. And what we were doing there was providing leverage to retiring business owners that were looking to execute their succession plans through leveraged management buyouts. And so that was a great solution for business owners that had internal bench strength to, have their existing management teams take over from them and run the company going forward. But what I was hearing a lot from the founders that I was speaking to at Monarch Bridge was, this is great. I love the idea of taking some chips off the table. And, I am in the middle of succession planning, trying to figure out what to do with my business. But what you're not bringing to me here is any solution to allow me to actually retire, because, I don't have somebody internally that I can point to say, this is my next CEO of this business. And so myself and my partner, Glenn Silvestri at Sage, we've known each other for about 10 years. We were actually introduced to each other by Mario Negro. And, we'd been talking about launching a fund together for probably 7 of those 10 years. And Mario, frankly, had been pushing us to explore the search fund space. And, our initial response to Mario was like, are you crazy? We're going to put a fund together and then give a whole bunch of money to some young entrepreneurs that are just graduating from their MBAs. They have no operational experience. Sounds completely bizarre and crazy to me. So we kind of sat on the sidelines for a while and watched this. And then we started to dabble into it a little bit with our own money and continued to watch and continued to see, just how this space was evolving in Canada and more so in the United States. And eventually we got to the point where we had arrived at a point in our careers where it made sense, where we could both exit our roles in traditional private equity and jump into Sage. And so we launched Sage Capital Partners in November of 2019. And Sage is an investor in many search funds. And we set up Sage really to address a bit of a need that we saw in Canada to, basically have an institutional quality investor that, folks in Canada could gain access to this asset class. And so Sage is really the first institutional fund set up in Canada to focus exclusively on searchers that are looking to acquire Canadian businesses. And that's really our niche. So we'll support searchers from all over the world. We have, many searchers that come out of the prestigious, US MBA schools. We have searchers that, grew up in India, grew up in South Africa, searchers from kind of all over the world. But the thing that sort of unites them all is that they come to Sage because they're looking to buy a business in Canada. and that's our niche. And so that's what we do at Sage Capital Partners, and that's why I was asked to speak today. If we can go to the next slide, I'll get into some of the slides. Yeah, so we can go to the next one. And so why did we start Sage, and why do we invest in searchers? Well, you know, it sort of really comes back to succession planning and, you know, the opportunity set that we see in the lower middle market for all of these businesses that are out in Canada that, you know, are looking at succession planning, trying to figure out what should we do with our business going forward. You know, I'm at a stage where I'm looking to retire. I don't have that, you know, CEO that's the obvious successor. My kids maybe don't want to have anything to do with the business. So what do we do with the business? And we feel like the search model is a really, really good solution for those retiring business owners, because not only does it allow for talented, really talented young entrepreneurs to get into business ownership, perhaps at a stage where they may not otherwise have the opportunity to do so. But, you know, it sort of marries up these really young, not really young, but, you know, young searchers that are just sort of hitting the prime of their career, and it marries them up with founders and people that are maybe at the tail end of their careers. And it allows these two to get together, and the founding entrepreneurs get to mentor the young entrepreneurs as they're looking to acquire these businesses. They work with them, and you know, they're a key part of the transition of the business. And so we feel like there's a lot of opportunities, particularly in Canada, where there are a large number of small businesses available, and certainly where there are many business owners who are, you know, baby boomer generation business owners that are looking to transition over the next few years. The other thing that we frankly really like about the model is that when you're talking about the lower end of the mid-market, and what I mean by that is, you know, typically the size of the businesses that we're looking at acquiring with our searchers is, you know, around between 1 million and say 6 million of EBITDA on the high end. And so these are smaller companies that generally don't attract anywhere near as many buyers. So traditional private equity, they don't tend to come to the table, you know, looking at these businesses until you get up to around 5 million or higher in EBITDA. So you've got fewer buyers, less competition. You've got, you know, fewer bankers that are at play, that are, you know, marketing these deals. And so again, less competition on these deals. And the result is you can buy these companies at lower multiples, which is obviously great for returns. Secondly, you know, we believe that the search fund model is really highly effective and a cost-efficient means of finding these lower middle market companies. Because one of the things that we routinely hear is, you know, it's great to kind of focus on these lower middle market companies. There's a lot of really strong companies out there that have been managed as lifestyle businesses, but how do you find them? And as a small, you know, private equity fund like Sage, you know, it's difficult to have enough bench strength and to hire enough bench strength to go out and scour the market for all of these opportunities. And so the search fund model is absolutely brilliant for that, because you invest in a traditional search fund, you put in your $50,000 or $45,000, $50,000, $55,000 to get a seat at the table. And then those searchers, you know, they'll go out and hire a team of interns. They'll have and the interns are all typically unpaid, but they end up with a nice sized team that are all out actively scouring the market looking for these opportunities. And so it's really a great way to leverage your search capability by investing in this asset class, because they are, you know, typically these businesses are difficult to find. And these retiring business owners, you know, in some cases, they've been thinking about retiring for a long time. They keep pushing the ball down the road, but they never, you know, get around to hiring somebody to actually help them do this. And so it sometimes takes a cold call from a searcher on the right day to find these opportunities. So at Sage, you know, we've invested in 10 traditional search funds. We also invest, as Karen spoke to, we also invest in non-traditional or self-funded search funds, and so we've, since the launch of the fund, we've invested in 5 search fund deals. We've got a 6th that should close by the end of March. And so, we've hit the ground running since our November launch. Let's go to the next slide. So setting the stage, I've talked a little bit about this, but I think it's important that when you look at the Canadian small and medium enterprise landscape, it's a very, very important piece of the Canadian economy. And if I won't repeat all the stats on here, but certainly when you look at employment in Canada, a lot of the employment in this country relies on businesses that have 50 or fewer employees. And when you look at exports, it's a big chunk of our exports are coming from these small companies. And so on a per capita basis, we have an awful lot of companies that are right in the target size range for searchers. And so in our view, it's a really great country to be in the search fund space and to be looking for opportunities. And again, that's just another reason why we are so bullish on investing in search funds that are targeting Canadian businesses. Let's go to the next slide. This one I'm going to skip over because I think Karen did a great job of describing, exactly how the search model itself works. So let's go to the next one. How does Sage fit into the search fund model? The reason I've included this slide is because we often get, there's a bit of confusion, frankly, with our investors in the fund and how Sage fits into the model. Because is Sage Capital a search fund, or is Sage Capital, how does it fit? And I think the way to look at it is the search funds are, the individuals, and whether it's a sole searcher or a partnered search where there's 2 individuals that set up a fund in a traditional search, they set up the fund to then go and find one company to acquire and operate, and then exit at the end of that period. And so that's a search fund. For Sage, where Sage fits into the model is that we invest in multiple search funds. And I hate to use the term fund of funds because we're not a fund of funds, but what we do is we invest in searchers and support searchers. And that's, the way that we put our portfolio of small companies together is through investing in searchers and search funds. But we're not ourselves a search fund. The best way to look at Sage is that we're a small private equity fund that just happens to focus on investing in searchers. And so that's how we fit into the model. We'll put in our, $40,000 or $50,000 into a number of different search funds. And then those search funds will go off and look to acquire a company. We work very closely with all of our searchers, help them through the search phase. We help them do the diligence on companies. And then when they find a company to acquire, we'll again help them with their financing. So we'll work with the banks and help the searchers get through that part of the process. And then post closing of the acquisition, Sage always takes a board seat, and part of that is just to take account of the fact that these are typically relatively young new CEOs that take the reins of these companies. And so at Sage, we feel like we want to at least have some oversight and sit on the board and provide some mentoring capabilities to work with these young searchers and young entrepreneurs to help them run these companies successfully and ultimately get to a successful exit at the end of the road. Let's go to the next slide. So, I think this is the one that everybody's probably waiting to see, and that is, how do the returns compare in investing in search funds compared to some of the other asset classes such as venture capital, private equity, or even the S&P 500. And so on this slide, you'll see the historical returns of search funds, and this is based on information out of the Stanford report that Karen referred to in her discussion. And so, I highly encourage everybody, if you're interested in search funds, getting your hands on the most recent Stanford report is probably a really good place to start. And in fact, when we were raising our fund, we actually had that as part of our marketing materials so that people could really get an understanding of this space, because it's something that's certainly not as well known to Canadian investors as it is to the US investors. So
And John, it's our intention to share the link to that study so everybody will have access to it. Yeah. Great.
It's a really good resource. And so some of this information here, you'll see it repeated in that Stanford study. If you look at search funds overall and look at the returns historically of these deals, average returns are 36.7%. If you take out, the top 3 outliers, which include Asurion, and again, that was one that Karen talked about in her discussion. Asurion is kind of the poster child of the search fund space, and was just astronomical returns in that case. So if you remove the top 3 outliers, you still end up with 28.8% return. And even if you remove the top 5 outliers, you're into 26.7% IRRs for search funds investing. How does that compare to venture capital? Venture capital, as you can see, was 19.3% over the same period. Traditional private equity, 15.7%, and then the S&P over that period was 11.8%. And so, you can see that the return profile of search fund investing is certainly, very, very strong, and certainly, worthy of a second look. The other thing that's interesting is if you look at the multiple on invested capital, in our discussions with a lot of our US co-investors that have funds that look like Sage, we've talked to a lot of them about the returns that they've seen over their funds over the last, call it a decade. And, net returns come out right around where this is indicating, in that sort of high 20% range to the mid 20% IRR range. And then on the multiple of invested capital, they tend to be right up around 3 times. So just under, like about 2.75 to 2.85 times multiple on invested capital, based on our discussions with investors in the US in this space. And so for us at Sage, we're kind of targeting 30% returns and a 3 times multiple on invested capital, which compares very favorably to both venture capital and private equity. Let's go to the next slide. And then this slide is just sort of meant to talk a little bit about the distribution of search fund returns. And I think one of the questions that we often get is, what happens if a searcher doesn't find a deal, and how often does that happen? And so historically, about 26% of searchers don't find deals. And I think, to be honest with you, I think that number has probably gone up a little bit, and is probably closer to about a third, or 30%, 33%, somewhere in that range is my guess. That the searcher success rate is probably around 70%, let's say. And so in 30% of these cases, what happens is you end up losing your search capital. And so it's a relatively small investment of that 40 or 50 grand that you put into the searcher's seed capital, that that you then work with the searcher for 2 years, and while they're looking for a deal. If it's ultimately unsuccessful, then yes, you lose that capital. But in this example, we kind of said, well, if you have a portfolio of searchers the way we do, and say it's $100 portfolio, what does that translate to? Well, that means if you invest $100 in the portfolio, about $99 of that, will go towards searchers that actually find a deal and get through the process. And then of those, a certain portion are going to lose money, in that they won't, get your money back completely. And that's about 28%, but 72% of those are going to make money. And then the part that's really interesting is when you start to look at the returns of the ones that actually make money and have found deals and end up with an exit that makes money. Where do the exits end up coming out? And you can see here 32% of the time you'll get between 1 and 2 times multiple on your invested capital, but 41% of the time you'll end up somewhere between 2 and 5 times your capital, your invested capital, and then 20% of the time you'll end up 5 to 10 times your invested capital. And so the returns, are kind of distributed in a way that, the 2 to 10 times range is actually the majority of the returns in search fund investing. And so it's I think on the next slide, maybe we'll go to the next slide. It puts this in context when you look at traditional private equity and, just your average traditional private equity fund versus the top quartile private equity fund, and then compare that with search. And what we're trying to show with this slide is that on a risk-adjusted basis, search funds returning 0 to 1 time. So, losing money on a search fund happens about as often as it happens in traditional private equity funds, and slightly more often than top quartile private equity funds. But what's interesting about that is if you look at the returns on a risk-adjusted basis and keep that in mind, then you go down and you look at, okay, well, how many times does it end up in a 1 to 2 times? Well, a third of the time for private equity, you're ending up in a 1 to 2 times multiple on invested capital. And then, in the 2 to 5 times, it's roughly similar, how many of your deals will end up in that range. But the part that's really interesting to us is in that 5x plus multiple on invested capital, when you look at search funds, they really stand out as, 27% end up in that range. And so it's, again, on a risk adjusted basis, we feel like the return potential of search funds far exceeds traditional private equity, which is, why we're in this space and why we think it's a really interesting space to be in. Let's go to the next slide. I won't dwell on this one too much, but I think, the other thing that's interesting about the Canadian market for search is that the US market, we're not reinventing the wheel up here in Canada. The search market in the US, as Karen talked about, has been around for decades. It's very much institutionalized asset class in the US. The terms of, and Mario will talk a lot more about this, but the terms of these deals tend to be relatively set in stone. And a lot of our partners in the US have really done a lot of the heavy lifting, frankly, on coming up with terms that work and creating the vehicle for these searchers to go out and find these deals and get deals done. And so this is, again, why we felt at Sage it made a lot of sense to have a Canadian focused institutional search fund investor and launched our fund. Let's go to the next slide. This one, again, I won't dwell too much on this other than to say that, at Sage, we felt like due to the fact that our anticipation was that there was going to be significantly less searchers in Canada than there are in the US that are looking to acquire Canadian deals, we felt like we needed to maintain, our flexibility to not only invest in traditional search funds, but also to support searchers that were, mid-career professionals that were looking for, an opportunity to acquire a company, and then also the self-funded searchers. And so at Sage, we will invest through all kinds of different models. So it's traditional search funds. Yes, we've got 10 of those in the portfolio and are adding more all the time. But we'll also, work with repeat entrepreneurs, we're calling them, or people who are, executives that have, or maybe a little bit older, have a little bit more operating experience and more of a track record, and we'll work with them as well on search opportunities. And there's a lot of those individuals out there as well that need some support. So let's go to the next slide. So I guess in summary, why do we like the search fund model, and why do we think it's worthy of investigation by Canadian institutional investors? It allows you to invest a relatively small amount of money, gain access to tremendous deal flow. And if you look at the independent searchers or the self-funded searchers, there you're not investing even the seed capital, and you're still getting access to lots of deal flow there. So it's certainly a very economical engine to originate deal flow in this lower end of the mid market. And then once you fund a searcher, one of the things that we also really like about this model as investors is that it's not like in traditional private equity when you need to make a change at the CEO level, and you end up maybe you hire a headhunter or something, and you do a couple of hours of interviews, and next thing you know, you've made your decision, you hire a CEO and you hope for the best. In this case, you get to spend 12 to 24 months with the person that you've decided, hey, this is going to be a CEO of a great company that we find together. And you get to, it's an inherent redundancy in the model where you get to assess the abilities of that CEO searcher that you've decided to support and to back. And you get to see how they work, and you get to form your own view as to how well they're going to perform as a CEO. So that's another thing we really certainly like about this model. And the other thing we like is that when the searcher finds the deal, you've got an option, but not an obligation to buy into the business based on your own diligence. And so, if we find, if one of our searchers finds a deal, and we either think, we've worked with this searcher for 24 months, they found a deal, and much as the deal looks like a decent deal, we just don't think this searcher is really cut out to do it, then you don't have to invest in that next round. And likewise, if you've got a great searcher that you're really supportive of, and they find a deal that you just don't necessarily like for whatever reason, or it's in an industry where you just feel you don't want that exposure, then again, you have an option to invest in their business, but you don't have an obligation. And if you choose not to, you get a 1.5 times step up on your capital. So if you've put your 50 grand in, you'll get either $75,000 cash back for that money, or you'll get $75,000 in the business that they ultimately end up acquiring in equity, and hopefully down the road get your money back. So that's another part of the model that we like. And it's also, as we said, certainly a lot less costly than hiring a whole group of analysts to put $50,000 into a group of searchers. And I think the quality of the searchers that we're getting is tremendously high. And so, we get a chance to, selfishly, Glenn and I get a chance to work with some really talented individuals, and that's fun, and it's exciting, and it's certainly a great way to invest. And then the last point that's not on this slide is, I think as a group of investors, like many of the people on the line here, I think one of the things that you'll need to determine for yourself is, how you want to go about doing it. Because ultimately, there's a couple of ways to do it. You can either, try to get into this space and sort of go directly into search funds and find a couple of 2 or 3 or 1, whatever you decide you want to do. And invest in the searchers directly, or there are funds. Well, there's Sage, and I'm obviously biased in terms of what Sage offers. We offer a chance to diversify your exposure so that you're not just putting your money into one searcher or 2 searchers. You're putting it into, at the end of the day, probably 15 to 20 searchers, and that's what Sage does. It takes a lot of the time investment that you'd have to put in to getting yourself ingrained in this space, and it instead offers you this chance to diversify your exposure to the search fund class. And that's what a lot of our investors have found to be the thing that they like, most about investing in Sage is that they don't have to spend the time to get into the search fund community as much, and they get an opportunity to have exposure to most of the searching that's going on in Canada through the Sage investment. So with that, I think I'm at the end of my slides, and so happy to take any questions from anyone.
Well, thank you, John. That was very, I think, informative for everybody. We have that one question still out there. What's sort of the horizon from that you guys are anticipating or have experienced from making an investment in an acquisition to ultimately past the value creation to the exit?
Yeah, so I mean, for us, you got to keep in mind that the fund was only launched in November of 2019, and so we haven't exited from any of our deals yet. But that being said, would we expect an exit or two in the next year or so? Potentially, yeah. I mean, I think as I talked about earlier on, I think the time horizon to exit has certainly shortened with the fact that there's so much capital in traditional private equity. And once you build these businesses to a size that attracts interest from traditional private equity, you start to get a lot of phone calls. And so, some of our CEOs are already getting phone calls, and we've only been in these businesses for, a year and a half. And so, I think in the early days, is it likely that you'd get a chance to exit? Potentially. But I think you've got to weigh that against, the additional growth that you may experience by holding onto these companies a little bit longer, because in a lot of cases we've only just been implementing our growth strategies, and so there's lots of room left to grow these. But I think the other part of your question that I'll answer is just at the outset, when you make an investment in the search fund itself, you also have to factor in that, okay, on day one, I'm going to throw my $50,000 into this particular search fund. You got to anticipate that historically it's taking between 18 and 24 months for the searcher to actually close a deal. And so, it may be 2 years after you put your initial investment in before you get to the stage where you've got a deal that's closed. And then from there, you have to add on your, 3 to 5 year or 4 to 6 year investment time horizon. And so that's why in our fund, we set up our fund as a 10-year fund with a 6-year investment period. And that's to take account of the fact that if we invest in a search fund in year 2 or even year 3 of the life of our fund, then you need a couple of years. You need to factor in a couple of years to get the searcher to a point where they find a deal to buy. And then you've got that hold period to get to the exit at the end of the day. So it's you got to be sort of clear on the time horizon that it's not necessarily a quick fix.
But I think from coming at it from a startup investor's perspective, often the exit is very opaque in startups, whereas as an investor in this model, there is as you've got the rigor and the discipline of you and Glenn as fund managers, where you have structured something into the deal with an ultimate exit horizon. I think that's a value
for sure
to accredited investors as they're considering other asset classes. Anecdotally, I hear stories like I've invested in 50 startups, been in there for 10 years, and I'm not sure when the exit's coming.
Yeah,
I don't see that. I don't see that in this space.
No, and certainly, I mean, the other thing in this space is that all of these deals are cash flowing businesses, and so there's none of these are companies that I would qualify as startup companies. In some cases, you may end up with a software as a service deal, for example, that maybe has slightly under that $1 million EBITDA number, but not much. Like it would be maybe 800,000 of EBITDA or something like that. So they're all profitable businesses that typically have been around for more than a decade, and And so, you know, it's quite a bit of a different scenario where, you know, you're not having to build the car. Instead, you want the searcher to step on the gas pedal of the car. So the car's already built, the business is already there. It's been running profitably for a number of years. And, you know, it's either been run as a lifestyle business where there hasn't been a real focus on growth, or they just need somebody to come in and turbocharge that growth to take it to the next level. And that's where the searchers come in. And like I say, they step on the gas pedal of the car as opposed to having to build the car from scratch as they would in a startup.
They're bringing best practices, innovation to
Correct.
The previous founder may not have the stomach for anymore based on their own risk profile.
That's right.
Yeah. Well, any other questions, guys? Please post them in the chat, and we'll try to. I think we've covered most of what's come up so far. Well, thank you, John. I think we can introduce Mario and hand it off to Mario.
In just a moment. So Carl, I just want to raise that we will be taking a break, everybody.
Okay.
Probably in, Mario, why don't we let you come on for the next 20, 30 minutes, and then we'll take a break after that. It's just a short break. It'll be about a 5-minute break. Mario, does that work for you?
Yes, it works for me. Perfect.
All right.
Great.
Over to you then. And
Thanks.
don't forget to introduce yourself, please.
Well, thank you, and it's a pleasure to be here today and to be here, particularly with such a great panel. The search fund space is still a growing space, and in a short period of time, it's been able to attract some pretty incredible talent. And I think you're seeing the talent, the panelists here, myself excluded, but the other speakers on this panel show you the dynamic nature of the space and the growth, and it's wonderful to see. And I'm going to be talking today about search fund deal structures and the limited partnership agreement, and probably bodes well for my profile. I'm a partner at Stikeman and Elliott in the Toronto office. My practice focuses on private equity. I've been practicing law for over 20 years, so heading towards 25. My practice is focused on kind of 3 buckets. One of them is cross-border private equity, particularly with US mid-market and lower mid-market private equity firms. 2, it's working with entrepreneurs, and that's how I got introduced to the search fund space. I was doing sole purpose vehicles. You might remember that. We used to call these type of deals sole purpose vehicles, management buyout, entrepreneurial deals. There's all kinds of names for them before the search fund name became popular. And that's how I was introduced to the search funds. And then I also do work for foreign investors into Canada, particularly from Europe. And so my introduction to search funds came many, many years ago when they were looking for someone who understood what they did, which really was, as you can imagine, raise capital in fact, in the search fund model at a couple of stages, and a lawyer who would understand that model, particularly when it comes to, lower middle market and middle market companies. And so I did my first search fund deal about 12, 13 years ago. At that time, it was one of the earliest search fund deals. And I've done most of the search fund deals in Canada from the legal side, which now is, I would say we're probably over 30 or 40. And then I've also invested. I'm probably the individual, somebody said to me recently, who's probably invested in most search funds. That doesn't mean I invest the kind of money that Sage does, but I now have the opportunity to invest in most of the search funds myself. So it's really my commitment to the space. So I would say I'm pretty much, as you'd say, 100% all in, as they say in Texas Hold'em, when it comes to this space, and I'm a true believer in it. And so I'm going to jump into the presentation and try to be quick. And there's a lot of ground to cover, and so I'm happy to stay and take questions. And frankly, if we don't answer them all here, just call me, and happy to answer questions separately. So So, I want to clarify something that I think Karen really did a great job of signaling to the group. Particularly in Canada, it's an important distinction. So in Canada, when we talk about search funds, the name has really become overarching. So it's important to note that traditionally a search fund has a very specific meaning, or now people call it the traditional search fund. And the traditional search fund is going to spend most of my time on, but I think it's important to understand that what Karen talked about, which is called the self-funded model. I'm going to try to parallel while we discuss the differences between the self-funded model and the traditional. But for the purposes of these slides, very important to know we're talking about the traditional model. So what is the traditional model? And the traditional model is the idea that an individual or two individuals, who have a kind of entrepreneurial focus, try and raise money to basically spend 2 years going to look to do a deal to acquire a company. How does it work in Canada? Well, I mean, similar to the US, it kind of flows a lot out of the MBA programs. But as we mentioned earlier, a lot of the Canadian searchers are older. And so, it's very, very organic, which is what makes it interesting, very entrepreneurial. The people who do this, frankly, are people who want to own a company. And as you probably know, in our Canadian marketplace, particularly when it comes to the middle market and the lower middle market, we don't have many private equity firms the US does. We don't have the kind of private capital. A lot of capital in Canada is sucked up by the pension funds. And so there's this kind of gap in the lower middle market for buying companies. And it's created this opportunity. And the opportunity is for motivated individuals who want to own a company to be able to step in. Now, the way it happened here in Canada was the US had already been doing this for 20 and 30 years. And we had Canadians who were coming out of those programs in the States who knew about the model and said, wait a minute, why can't I do this in Canada? And so that's where the growth of the model has been, but it's taken on a whole new dimension now, where you have individuals who have the finance background, who have a private equity type experience, who say, well, look, I can't raise a fund. I might have been working at a PE, I got clients who, might have worked at a PE fund for 10 years or 5 years. So they got PE experience, they got an MBA. Can't raise a fund, but they still want to do a deal in Canada. And the search fund is a super attractive way to do it. I want to highlight the characteristics of the searchers for 1 second, which is, look, this space has created its own legitimacy because of the quality and the content of the people involved. And so what makes this space unique is the searchers are high quality individuals. This is not a space for somebody who doesn't have a business background, doesn't know how to own a company, doesn't have any experience at all in business, right? We kind of do look for people that have an MBA. We look for people that have some semblance of a work experience in either finding a deal, closing a deal, or running a company. And so there is I'm sorry to say the word, a bit of a self-selection process, right? I mean, you don't have experience with these things, and you come and talk to us and say, Mario, I want to do this. It's kind of hard. I kind of have to push you to say, look, it's hard for you, right? There is a certain skill set that comes from this. And part of it is what's made the space successful is the people that do it, who come to us and do the initial raise are people that have the skill set to do it. And so those people want to get started. They want to do it. What's the first step they have to do? They have to draft a private placement memorandum. And it's the key marketing document when you do the first part of a search fund, which is what's called the initial raise. And as people before have said, the initial raise is based on the idea you raise $40,000, $50,000 from 10 to 12 people, and that becomes a fund in and of itself. So you want to call it a $500,000 or $600,000 fund. That $600,000 fund is then what's used for 2 years to go out and search to find a deal. Your private placement memorandum is your marketing document to get that first $50,000 from 12 people. Okay? It's key because it tells a story about you as a searcher, but it also tells the story to the marketplace about how you're going to go find a deal, how you're going to close a deal, and how you're going to run a company, or we like to say the 100-day plan. And so the document is key. It's key traditionally in the search fund model. It's not possible in the traditional search fund model to really raise a fund without the private placement memorandum. It's a well thought out, well established document. It creates legitimacy. And so, most people that we work with on this phone call will tell you when we analyze a searcher, we're analyzing their PPM. It's a key driver of who to invest in and who they are. And frankly, it tells us a lot about the work that they put in to make it happen. Now, to be clear, if you do a self-funded model, you're not going to do a raise of 50,000 times 12. You're just going to go out and look for a deal. So you're skipping a lot of this. And you know, you go straight to the deal searching mode, but of course, then you don't have, as you'll see in a few minutes, all the benefits of what a traditional search model brings. Okay? So now you've drafted your private placement memorandum. You're ready to go. You want to hit the marketplace. What do you do next? You do an investor outreach. And the reality of it is, for the people on this call, you know, people aren't going to go to you. Please don't take it the wrong way. There is a stable set of investors that people want in this model. They tend to be American. And in fairness to them, Americans have been very loyal to Canadian searchers. And frankly, the success of Canadian search funds is because of American investors. And so traditionally, the outreach that's been done by Canadian searchers has been to US investors. It's growing. We're definitely seeing more Canadian investors, which makes it even more exciting. But well, where I would say to you, part of the legitimacy of the space has come from is because these people reach out to U.S. investors to raise that first $500,000 or $600,000. Okay, and that legitimacy comes with also, as you'll see in the next point, it comes with accepting what those American investors want. So in Canada, unlike some other countries, we haven't created a local form of document with respect to the initial raise. So sometimes Canadians who are new to the space say, wait a minute, I'm putting $50,000 in a LLC, you know, that's the limited liability corporation operating agreement, a kind of US Delaware model agreement. They get a little nervous because they say, whoa, hang on, you know, I'm a little antsy, you know, being subject to US tax rules. You don't have to worry about that. The reality is why we do it that way is because the space in Canada is still dominated by US investors. And again, no offense to Canadian investors, but you go where the action is and you follow the money. So we follow the money in the space. And, you know, the US investors have the deepest pockets, the traditional US search fund investors. They're the most committed to the space. They come to the table, and having them on board creates legitimacy. So, and frankly, the history of success in Canada, the searchers that have really done well have all been with a core group of US investors. So even you as an investor like to see search funds with US investors because it generally means success. So the LLC operating agreement and searcher terms are pretty standard, as John mentioned to you. So when search funds buy into the US model, buy into the US investors, they also at the same time buy into the US terms. And that's why another reason we use the US document, and you'll see it on an initial raise, because our job isn't to rock the boat, it's to get money. And so when we're trying to get that first money, we don't kind of get too fussed about terms, because honestly, it's either get the money or don't do a fund. And so searcher terms tend to be pretty standard. We're going to talk a little bit later about searcher terms in the deal phase, but they're kind of baked in right now. And I want to highlight three particular things in that LLC agreement. Why would somebody put $50,000 at this phase? Seems, you know, not enough to make a difference for, you know, some of these funds in the US are $200, $100, $300 million funds. Why? They're basically getting a first right on the ability to invest when these searchers find a deal. So the lock-in at this phase is a pro rata right for the equity portion when they find a deal. So that's the advantage of getting in early, and that's the key point for these investors. Another thing they're getting is they're getting a step up. So when you put that $50,000 in first, for the first 2 years they do the search, if they find a deal and you get to the point where they close that deal, your $50,000 gets converted in the deal structure to 1.5 times. So you actually make 50% over 2 years. So there's an incentive, an economic incentive to do it as well. It's not, you know, obviously a lot of money, but it is an appreciation for the fact that you were in early. You get the 50% step up. And then finally, you know, these funds are set up to find deals. And so you, as a investor, are now going to see, and we'll talk about it in a second, deal flow. And deal flow is key. And that's what a lot of these investors are buying. As John will tell you, you know, you get in early, you get to see the deal flow of the investor, so of the searcher. So you as an investor get to have a say in what they actually decide to invest in. Okay. To be clear on the employment consulting arrangement, you know, people say, well, okay, Mario, so how does this work? What does this person do? Well, think of it as being a full-time job. You can't be a searcher in the traditional model and other than having looking at it as a full-time job. And so you would essentially, if you close your fund, you get your $500,000-$600,000, you start your search, it's a full-time job. You commit as part of your LLC agreement to do this full-time. Whether you want to pay yourself as an employee or as a consulting arrangement, it's pretty open, it's pretty flexible, but make no doubt about it. You can't be doing this with another job. This is a full-time commitment. And so that's a key part of searching. And there is no ability to do a traditional model and be part-time. And frankly, I would even argue on the self-funded model, which of course you don't have to worry a lot of this because you're going to go out and look for a deal. People don't take you seriously in the space if you're not full-time. It's just the nature. No sell-side advisor takes you seriously. No bank. Nobody's going to take you seriously if you say you're doing this like in the evenings after your day. You got to show the marketplace you're serious. So I'm going to go on to the next page. Talk about deal structures. Okay, so now you've closed your fund, you've raised your money, you're out there looking for a deal. What makes search funds unique? Well, what makes them very unique in our marketplace is the fact that unlike traditional private equity, who really does focus on sell-side advisor deal flow, search funds actually are well known in the marketplace as being, and particularly in Canada, as being the leaders of what's called proprietary search. They actually go out to the marketplace and find deals on their own that are not being marketed. They go talk to owners directly. And it's a very unique part of the space historically. And it makes, for one of the key reasons why search funds have been successful is the fact that they, frankly, more than most large private equity firms, have developed mechanics and processes to go find deals on their own. And so it's what makes them unique. They actually hire a lot of students to help them. They'll do what's called vertical analysis. They'll actually start looking at sectors. So basically, to give you what's called the typical funnel approach. Let's say you're interested in business services in, distribution of whatever. Let's just say food. You go out and find through your search, whatever, 1,000 companies that you know of in the Greater Toronto area that do distribution of food. You kind of take that, you determine the size, if they fit into your bandwidth, you do an outreach, if they talk to the owner and say, listen, would you be interested in talking? If they're interested, you talk to them, you sign an NDA. If they're continued interest in potentially a transaction, you take it from there and sign an EOI. All this is happening directly between the searcher and the owner. No intermediary. It's high risk, but it's also high reward, leads to better transactions and from a multiple point of view, but it's what makes searchers unique. Now, as the pros and cons of searchers, of course, this model has its downfalls, which is, of course, a lot of owners, as you know, if they don't have an intermediary, find it hard to get over the line. So that, many searchers will tell you, working with owners directly has benefits because, you don't have to deal with the dynamics of a sell-side advisor and a process and a competition. But it's also negative because without the institutional support that brings, it's hard to get a deal done. So I would say to you in Canada, as much as there is a world of proprietary searching, a lot of searchers, probably even more than 50%, but it's probably 60-40 in Canada, still find deals through sell-side advisors. And what's the pros and cons of a sell-side advisor and a searcher? Searchers are young. Sell-side advisors historically discriminated against searchers, kind of said, you know what, no owner is going to want to talk to you. And so that became a problem in the early days. We're over that problem now because the searchers have proven themselves to be good buyers of lower middle market companies. But there still sometimes is a negative connotation to searchers. Where does your money come from? How can you have, all the negative language that comes from, wait a minute, you look too young to be able to close a deal. However, searchers have proven themselves successful. They get deals done. Investors support them. And one of the key pros of a search fund over traditional private equity, and it's a huge pro for search funds want to run the company on day one. An owner that wants to retire and get out, who does a deal with traditional private equity, is usually forced to stay on 18 months, 24 months. Search fund has the ability to tell an owner, you want to leave, I'm here for you. I'll take over on day one. And owners like that. They like that element of it. They also like the element of the fact that they're talking to the person who's buying their company as opposed to talking to a more amorphous fund. Okay. You're looking for deal flow. You signed an LOI. The LOIs for search funds are very typical. People say, well, wait a minute, how do you sign an LOI when you don't know if you have any money? Good point. But the reality at this point is a traditional search fund has 12 investors. The searcher has taken their deal flow, shown it to their investors. Their investors have bought into the deal. So when it comes time to create legitimacy at the LOI level, what does a searcher do? Well, you don't believe me? Talk to my investors. They'll show you that I can do this deal. So the advantage of the investors is not just that the money, they're advisors. They also keep the searchers out of trouble by not getting them to do deals that are risky or the searcher basically takes their deal flow opportunities and potential candidates, shows them to their investors so that the investors have sign-in before they sign the LOI. It's the same process that goes with the banks. Again, the investor group adds its legitimacy to the search, and it allows for more certainty of closing. And so we've had many times when people like Sage will stand behind the searcher when they're told you don't have the money. Sage can speak up, call, talk, send a letter saying we're here, we're ready to go. Let's get going. We're happy to do this deal. We're happy to stand behind our searcher. And so it's created a lot of comfort in the space. It's created the legitimacy, and it's probably one of the key reasons why the space has been so successful is because traditionally it was the US investors stood behind the Canadian searcher, to the banks, to the owner. One of the first search fund deals we did in Canada was called You See It many years ago. And we had and that ended up being a 10X, by the way. And in that deal, what was a key issue at the time when they first found the deal is they didn't believe the two 30-year-olds could do a deal. And one of their investors literally came to the meeting with the owner and said, look, I not only am interested in this deal, I can write this check right now. And they said, okay, well, if you're telling us you can write the check, on we go. And so that legitimacy has proven huge. So valuation, deal terms, and what is attractive about search funds. I think John had mentioned this, so I'm going to be quick. The attractiveness of search funds because of the proprietary searching is deal terms that tend to be a little more purchaser friendly in the sense that, they're not caught in valuation battles. These companies tend to be, lower middle market, less buyers, they're not competitive process. And as I said to you earlier, what's attractive about search funds, the owners, the searchers are willing to step in for the owners on day one. They tend to put more equity in deals than traditional private equity. Search fund deals tend to have a minimum of 50% equity, 50% debt. And search funds are unlike, what can I give you, Constellation Software. They're not value buyers. They don't put in a 2 million EBITDA business, a 3X, So in our marketplace, search funds tend to do deals that have a 1 million to 4 million EBITDA span, and they tend to pay fair value for it. They're not cheap buyers like some others. And so in the lower middle market, search funds have developed a reputation as fair buyers who pay a fair price. So I'm going to keep going. So search fund fundraising, they got a deal now, they got an LOI, they got to start selling the deal to their investors. And so look, at this part, remember, like I said to you, and one of the hard part for all the people on the phone call who want to do more of this investing is there is a hierarchy in the sense that the traditional search fund investors, because they get in at the early stage, have a first right when they find a deal for their pro rata share. So sometimes there is no room for additional investors to join. You didn't get in early at the $50,000, initial raise. There's no room for you. However, as the deal space keeps growing and as the self-funded model starts to take precedence in Canada. And so this, I'm going to take a second to highlight the uniqueness of the self-funded model. In Canada, the growth of the space has really taken off on the self-funded model. And the self-funded model is the idea of more established, tend to be a little older, people who have some experience with private equity say, you know what, I'm okay. Remember, in the traditional model, you get a salary for 2 years to go find a deal. A lot of the self-funded guys say, look, I don't need a salary. I'm doing fine. I've worked in private, I've been an executive. I want to run my own company. And so they just go find a deal and they're willing to self-fund themselves until they find a deal. Okay. And then when they go out looking for money, they open up the investor base. They don't necessarily go to the traditional search fund investors, but they put them on the list. That's the opportunity probably for this group more than any to get in on what's called the self-funded model, because that's the growing space. And so in the traditional model, first right goes to the individuals who put in the money at the initial phase. And then if there's a leftover, we call it gap equity, then they'll go out to a broader world. And to be clear, when people put money in at the initial phase, when people put $50,000 in, their goal when it comes to the deal phase isn't to invest another 50. A lot of those American investors are looking for equity checks of 500, $1 million. I mean, even Sage, I believe Sage is generally looking for $1 million check. And so people use the 50 as basically a placeholder to be able to put $500,000 or $1 million when they find a deal. And so that's the other thing about this space. I mean, it's really, unlike a traditional venture space when you have a lot of smaller and the investments here, once they find a deal. I mean, look, we see investments as low as 50 or 100, but a lot of people who get in early are looking to get in early to kind of preserve a larger check. Okay? In this model, by the way, once you find what's called a lead investor, somebody who's going to put in a substantive check, they also are the one who negotiates your terms. And so, again, the difference is you don't individually negotiate terms in a search fund model. That would make this unwieldy. And so lead investors negotiate. So as you can imagine, but it should be an alignment of interest, the biggest investor or two generally is who's used to bless the deal. And then, of course, the searcher goes out to the marketplace and says, look, I got these investors in. Are you interested in coming in for some? And so, whereas, like I said, I'm an investor in many search funds, I'm rarely a lead investor. I don't question the lead investor on the deal. I go where they go because it's alignment. They're a lead investor. They do this. I trust them. Okay? Just to highlight the last point here, the dominance of the traditional search fund model. So investors, sorry. So of course, because the fact of the lead investor is so key, a lot of searchers will rely on the traditional search fund investors as their lead investors. One, because they know the space, they get deals done quick, and frankly, they traditionally are the ones who put more money in. And so it's important to note that the terms tend to be molded by those lead investors, and those lead investors tend to do what search funds have been doing all along. And we're going to get to that next. So I'm going to turn the page and go to the searcher economics. Everybody wants to know the searcher economics. So now you're trying to negotiate your key terms. And again, in these models, how these things work is you put your money in an LLC, you found a deal. At that point, let's say it's a deal in Ontario, whatever. It doesn't make a difference what province is in Canada, but we'll say Ontario, but you could replace this for any province. You found a deal in Ontario. We're going to create a limited partnership agreement in Ontario, an Ontario LP. Okay. The LLC units are going to be converted. Okay, at closing, your LLC units, first of all, either you like the deal and they're going to be converted, or you don't like the deal and you'll get 1.5 times. Okay, you don't like some people don't like deals. So at closing, they get $75,000. Let's say if they put 50 in. They like the deal, they roll their 50, including the additional 25, into the Ontario LP. Okay, so now what do they have? They have $75,000 worth of Ontario LP units, plus whatever they want to put in at the deal phase. Okay, so at that point, the LLC dies, it's gone. You own your units in an Ontario LP, and an Ontario LP is an investor vehicle. All the investors' money flows into including the Americans. Everybody works out of Ontario LP. You create an acquisition vehicle. It buys the target. We amalgamate. So the way to look at it is the Ontario LP raises the funds, it pushes it down into the acquisition vehicle, uses the money to buy the target. The acquisition vehicle is also the borrower in the loan facility. Again, in these deals, we'll talk about this in a second, but in these deals, the acquisition capital structure tends to be, unlike venture, their debt is a key part of the structure. So 30 to 50% debt, 30 to 50% equity, and then unlike larger deals, 10 to 20% what's called contingency, meaning a vendor take back promissory note, an earn out, a rollover.
some element of non-cash contingency that the seller provides. Okay. And that's what makes the economics of these deals attractive. And by the way, banks are supportive of these deals, hugely so, and very competitive. So, so we closed the deal. You invested in this vehicle. How do the economics work? Okay, well, now you're an investor in an LP vehicle. All right, time comes to determine distributions. Everybody's favorite topic. What am I going to get? So the way it works is basically your equity, your capital contributions are returned first. Okay, so let's say this vehicle starts to make money. The operating company is successful, and so they start returning capital. So first up, as we flow through the structures, you're going to get your equity back first. Second, this vehicle has a preferred return, generally between 6 to 8%. And so think of it as being a preferred return for the people who put equity in. So there is a minimum return, like all private equity. Okay. Third, there's a catch-up, a very Canadian thing. We push for a catch-up here. Catch-up meaning that the promoter, the searcher, gets an ability to catch up on their portion of the equity after the 7% is paid out. So first the capital back, then the 7% to the investors. We keep going through what's called a waterfall. Next up is the catch-up. Searcher gets to catch up. What happens next? Okay, well, now we break down what's left. So in our model, we break down and usually for a searcher in the traditional model, and frankly, even in the self-funded model, it's 25 to 30%. A sole searcher gets 25% and a dual searcher gets 30. What does that mean? Think of the economics as being 70% for the people who provide equity. We'll just say 30 for the searchers, okay? So the 30% is what the catch-up is. They get 30% catch-up. So their catch-up of 7% is on there, 30% of 100, okay? Now we have to split what's left. We paid the pref return, we paid the catch-up. When you split, you get to see the searchers promote in action. So searchers get 30%, but they don't get 30% at one time. 10% is vested at closing. 10% is vested over time. 1/48, so over 4 years. Every month, 1/48. 10% is performance vesting. It's very important to understand in the traditional search fund model, time-based vesting is key because one of the key attributes of a searcher in the model is that they're going to run the company, which makes them unique from traditional private equity. They have to run the company after closing. And so that's why you see a third of their carry is tied to time-based vesting. It's an alignment of interests. The investor wants them to stay there and run the company, and the model is based on that attribute. If they leave, their time-based vesting stops automatically. And then a third is performance vesting. So think of it this way: 10% vests at closing. If they were to leave immediately, they'd only get 10% of the 30. If they stay for 48 months, they automatically get 20. But even then, the last 10 is based on a performance vesting, which is in the search fund model. Generally speaking, now I would say you would get the other 10% would be tied to IRR returns of 20 to 35%. So a rate of return of 20 to 35%, and what they get is they got a kind of pro rata share. It's kind of linear, the way to look at it. So in better words, if they sold the company after 4 years and the company demonstrated a 28% return to that effect, then they would get half of that. If they got 35, they'd get, so half would be 5% of the 10. It's, like I said, it's linear, pro rata linear, okay? So it's a lot to chew on, but I think what you need to know, it's 3 things. It's not all at closing, 10%. Time-based vesting is very unique to the traditional search fund model. In the self-funded model, we've actually gotten rid of a lot of time-based vesting. And performance vesting is key to the model. So it ties the searcher to performance. Okay? Again, what's unique about search funds is they're also treated as an executive. And so they also get an employment agreement, and they're treated like an executive. They're a CEO. When they close their deal, they got to run their company and they got to deliver results. And so they're given a salary of $150,000 to $200,000 a year with a bonus structure of 30 to 40%. Okay. I know that's a lot to go on there. I'm going to quickly go through the last slide. So now you're in an LP agreement, you're going to invest. What does the LP agreement include? These are some key facts for you. These LP agreements are pretty baked in. They're structured a certain way. Hard for you as an investor to come and say you want to do it differently. I'll be honest with you. We generally refuse investors who get off the traditional model. So the role of the board is key. In search fund deals, the LP agreement provides that the board of directors is key for most decision making. That board of directors is made up of mostly investors and the searcher. So in normal cases, an example, you do a deal and the board would be 4 or 5 people. One of them would be the searcher, 3 or 4 would be investors. Okay? Sometimes one of them is a strategic person in the space, but you can see that investors always rule a board. So in some ways, if you as a limited partner feel as though you should have more say, or you feel like you need more say, this model's not for you unless you're going to put in the big money to be a board member. Because usually board seats are reserved for larger investors. But sometimes strategic decision-making, strategic input is important, and even small investors can become board members if they have other attributes. Okay. So like I said, limited partner decision-making is very focused on fundamental decisions. Okay. And those fundamental decisions are few, 3, 4, and they don't include selling the company. Selling the company is a decision that flows from the board of directors normally, okay? And so again, remember, the board of directors probably in and of itself owns more than 50% of the interests of the LP. So it kind of ultimately leads to the same place. It's important to note that in the search fund model, the searchers themselves do sit on the board. They are a key driver of decision making. The model itself is built on the idea that the board and the searcher are one together. So it isn't, if it creates a conflictual model in the search fund world is a disaster. This isn't a model where a board tells a searcher, do it my way or not. It's very reflective. It's back and forth. They work together. The model only succeeds because they work together. It's unlike a public model board or boards that focus on, we tell you, us board. No, because if you demotivate the searcher, you kill what the model's about. The goal of the model is for board members to support the searcher, be there, almost like a partial policy board, partial operational board. What happens when searchers leave? Like I mentioned to you earlier, they lose their time-based vesting, and they also lose, obviously, if they haven't performed, they lose their performance vesting. And so again, the reason for the collaborative relationship between the board and the CSO is key, is because when a company loses its CEO, it's in a search fund model, it's very detrimental. It's very hard. It is not easy to find a good CEO for a lower middle market company. And so you'd think that there would be, but a lot of good CEOs want a lot more than a 2 million EBITDA company can bear. So the search fund CEO is unique. And so you'll see boards are very protective of not pushing CEOs too far, and they really want CEOs to grow and flourish. Protective provisions for limited partners, just so you know, there are protections for limited partners, typical type shareholders agreement type profession that can't change your economics without you. You do have a preemptive right. So the kind of stuff you normally see. But the provisions that allow for an exit prior to liquidation are typical of a private company, which is you can't just go and find, we usually don't have ROFRs in these agreements. You got to kind of sell either to the general partner or to other limited partners. Okay? And how does the sale of the business work? This one is key because everybody asks me. Usually it's a combination between the CEO, the searcher, and the board. It's very, very unusual in the search fund model to have a board sell a company over a CEO's head. At the same time, it's impossible for a CEO to force a sale on a company. And so when we see a disconnect there, there's a misalignment. So usually, a successful search fund exit is one where a CEO and a board have really planned it out, and you can see it. Now, remember, if times are going good, it's easy to see an exit. But I would say to you, this really is a collaborative model on an exit. And by the way, I didn't say the LPs. I said the board and the searcher. The LPs kind of go for the ride. And that's, it's a lot to take in. Sorry, it's a lot of information. I hope it was helpful, and happy to answer any questions.
Wow, I was writing lots of notes, and I think we've got some questions that have come in, but what I wonder if we should take our break, because we've been at this for a while. And Mario, that was very meaty. People want maybe a couple of minutes. So why don't we take a 5-minute break? Hold on, let's make this more logical. Yeah, okay, so let's all gather back here by 10:55 at the latest, and Mario will answer any questions before we move on to the next part of the program. Is that all right? Mario, can you stay with us for that?
Absolutely. Yeah, I'm around.
Okay, everybody, see you at 10:55.
Wonderful presentation, Mario.
Oh, my pleasure. My pleasure.
There are so many facets to this that I don't get to see from my perch at Search Funder. So it was very interesting.
Whose cat was that? Was that your cat, Karen? That's a cute cat.
Yeah.
Yeah, Mario, that was really, really well. A lot of detail. I think that's very valuable to the investors exploring this.
Sorry, tried to go quick. There's so much there. I mean, we could go on, but I hope it wasn't too long. I tried to keep it as quick as possible and move along quickly. So.
And Carl, what's the time clock? Am I I think, am I up and then Dan is the closer?
Yeah, you're up next.
I like that I'm called the closer. Thanks, Steve.
A closer.
Sounds kind of awesome. Like you're,
Yeah. We've got it. We're actually just pitching a timeshare at the end of this, right?
Exactly.
Okay.
I'm here. Okay, welcome back, everybody. And Steve Rissler, how are you?
Good. Can you see me?
Yes, we can. So just before we move on to you, does anybody have any questions that can't wait for the panel at the end of this session that they'd like Mario to respond to? I'm just waiting to see if there's any quick typing going on or.
Yeah. But as questions come up, just please put them in the chat. We'll make sure that if they aren't addressed throughout the presentation, we'll ask them at the panel discussion at the end.
Yeah. Okay, then I'm going to move on. Then Steve, we're going to let you take over, and thank you very much.
Awesome. Cool. And I don't know, I don't have slides, so this is going to be a little bit of a lightweight kind of, I'd say a case study. I'm probably like a lot of folks on this call, an entrepreneur who ended up kind of being an investor and angel in technology. And now I do search investing. And I thought I would do today a little bit about my journey. So I think you've gotten like the gurus of the field to kind of really share what the field is and some of the best ways to think about the field. And actually in Dan as the closer, you have a successful search operator, now investor. So I really feel like you've gotten great initial content, and Dan will close as a search operator investor. I'm going to kind of give you a case study as someone probably like you in your shoes and how I got involved and some tips on that. So that's the goal of this kind of 10 or 15 minutes. Before I get going, I'll kind of tell my background, which will weave into search. So I'm from the States, if you can't tell. I'm originally from Ohio. For folks who like American football, I went to Miami of Ohio for college, kind of Ben Roethlisberger era. For folks that like hockey, we're also pretty decent at hockey at the collegiate level. I went to University of Pennsylvania for grad school under a government scholarship. Ended up spending 5 years in government and technology jobs. Afterwards, I launched my first company called GovLoop.com, which was a social network for government employees. And really, I ended up having a big Canadian presence. I've been to Ottawa probably half dozen times, and eventually grew that business and sold it to a SaaS software company called GovDelivery in Minnesota, which was more or less the MailChimp for government, which a lot of the emails and text messages for government, 4,000 agencies use that product. Now used out for things like coronavirus information, or if you're in Texas, your hunting license and all sorts of stuff. We sold that business to Vista Private Equity, which is the largest SaaS software investor in the world. I was the CMO as we bought 4 more software companies and really learned a lot about how private equity works. Vista is famous for saying all software tastes like chicken, which is a funny saying, but they have a kind of a famous playbook on running software companies. It's also what kind of got me thinking like a private equity investor of how you can improve existing companies that you buy, which is a lot of what a private equity playbook is, which is similar to search in some functions. I eventually left I joined a friend who had a small public safety software company, about 2 million ARR, and we grew that to 8.5 million ARR. And last year ran a process where we had 13 offers on the business, a number of private equity, which once again kind of got to see what private equity cares about at the next level, which I think, as John said, private equity is often the buyer of search-based companies. We ended up selling to a strategic, Motorola Solutions, and that was about 6 months ago. And so that's been my career journey, has been mostly around software, SaaS, GovTech, and private equity, which may make you wonder, why am I talking at this call? Because it's not totally related. And how I got into search investing was really just kind of a lifelong love of investing. So, as a kid, I had my Vanguard index fund and was a Boglehead disciple. Then I got into, Buffett and value investing and, books like, or folks like Constellation Software, books like The Outsiders, which is a great classic book on capital allocation, where the author's a big search fund investor, Will Thorndike. Eventually, I got interested in angel investing in kind of two communities. One, the Washington, D.C. tech community, where I live and where I'm based, as well as the government tech community, where I've made my money and where I've had fun and helped folks. And in angel investing in startups, what I love is, backing great entrepreneurs trying to change the world, right? So that's probably why a lot of you do it, is to be on the cutting edge of technology, helping folks with a vision. And then, in angel investing, you're trying to build a portfolio where, hey, with 20 investments, hey, maybe 10 strike out, but you'll get a couple grand slams in there and the IRR will shake out. And so I'd done a number of angel investing and met entrepreneurs. And then a friend of a friend had done search funds. And much like how Karen said, when you hear about entrepreneurship through acquisition, your first reaction is, I did not know that was a thing. For a lot of folks, that you could buy a business that was existing as a way to get into entrepreneurship. And I think a lot of serial entrepreneurs, maybe after their second or third exit, want to be an entrepreneur again, but don't want to start from scratch. And this concept relates to them in a lot of ways. Me personally, kind of heard about search funds. This is a great overview session. I think the key is, what we kind of say is, you go down the rabbit hole of search fund and learn everything about it, which I did for about a year. I encourage folks on this call, as a takeaway, that all these resources are great. I assume, we'll share some of this as a follow-up. The other kind of key places to get smart on search funds, I would start with Search Funder. Karen and her team have built a great website. There's kind of two definitive books. The first definitive book is a Harvard Business Review book on Guide to Buying Small Businesses. And so that's written by a couple of the professors up there. That's a great read. There is more kind of I wouldn't call it, quote, search funds, but more around entrepreneurship through acquisition. There's another book called Buy Then Build that's getting popular as well. It's another book around entrepreneurship through acquisition. Not always search, but it is interesting. There's also great materials online. If you like podcasts, the Polsky Center at University of Chicago booth, Chicago is one of the key places on search, has a great podcast. The person behind it, Brian O'Connor, is also a former searcher who now runs a search fund accelerator, which is kind of another part of the market of search. So that's a great podcast. And then another podcast I'd recommend is Think Like an Owner, which is kind of around buying small businesses. So I'd say if you come out of today's call and you're really interested in search, Stanford study, Search Funder, Buy Then Build book, the HBR Red book on buying a small business are great ways to just kind of get going and learn about the ecosystem.
Steve, maybe we could get you to put those reference points into the chat. That would be great. And we can also make them available through other means.
Okay, I'll put it in the chat. I probably can't multitask and talk.
No, when you're done.
When I'm done, or if any of my great colleagues want to do that, I'm sure everyone does what I'm talking about.
You calling out your peeps here?
My colleagues, yes.
There you
And then the second one was, probably like folks here, I'm like, hey, what is the best way to get involved? And so me originally kind of reading about traditional search, I kind of said, hey, is traditional search something I wanted to do as an investor at the time? And my math was, hey, to do traditional search, you have to buy a unit, which are kind of $20,000 to $40,000, and then invest on the deal, which is kind of say it's $250,000 to $500K. So to do that well and build a portfolio of say 20 searchers, it's a pretty significant operation. Say it's $5 to $10 million to do that well, and that's if you could even get access to the deal flow. As I think Dan and John can say, it's a pretty tight knit community. It's a very collaborative and mentorship community. So I think the community really focuses on making sure any investors value add and not just kind of throwing money into the ecosystem. And so for me, the easiest way to get involved was to be an LP in a couple funds similar to say a Sage or a Snowden out in Canada. Was a way for me to get access to traditional search. So I think that's kind of a great way if you want access to the category, and put a toe in, see if you like it, see what's going on, see if you like the kind of deals. The deals are different than if you've done startups, right? So while I love these businesses, they're not AI machine learning rockets or on the cutting edge. While there are software deals, a lot of them they've been around 10 or 20 years. So they're different. You're buying existing businesses and doing them better. My next evolution was, hey, I really liked traditional search, but I also wanted to get involved at kind of the deal level. So as an LP, as folks who've been LPs in private equity funds or venture capital funds, it's a great way to dip your toe in, but sometimes you want to be a little bit more involved or direct. I started getting active in the self-funded search community, which Mario was talking about, which are kind of a different approach. So not the 2 years and then the deal. So sometimes on self-funded, there's smaller deals and looking for some investors. So I got active on the self-funded search community. I say that the pro of those are you can put smaller checks together on direct deals. The hard part is I would say it's a little more of the wild west where there's not 2 years of getting to know folks. There's not 20 investors you normally know. You're really just looking at a deal with someone new. But I've enjoyed that, and I've done everything from I backed a Stanford Bain guy buying an Asian food wholesaling business in Austin. I backed a Harvard grad who bought a telecom cabling business up New York. I backed a husband and wife that bought a e-commerce female athleisure company, and really got to, what I enjoy about it is just kind of seeing the breadth of the economy in both the US and internationally. I've invested in searchers, both US and Canada and internationally, Brazil and others. So that's kind of been my evolution of the space. One thing I'll say as an investor, what I often find talking to potential investors, one evolution that occurs that kind of didn't quite get talked about today is some investors say, why don't I do this myself? And they kind of go into it and they say, hey, why don't, instead of backing 20 searchers or backing self-funded, why don't I go buy a business for myself to operate, which has kind of always occurred in life. It's just called buying a business. And so I've seen a number of investors do either they buy a business themselves and run it. That's their next part of entrepreneurship, or they will buy a business and put in a general manager. So kind of basically building their own little, sometimes they call them holdco holding companies where they might, if they're in Ontario, right, buy a small lawn care business themselves, and maybe it already has a GM, or maybe they put in a GM and maybe they take that one and buy another one. And so that's another part I'm seeing is there's a lot of diversity in the types of approaches towards entrepreneurship through acquisition over time. So They're originally just started with traditional self-funded search, then there was self-funded search. Then there were accelerators. We already talked about the one in Canada. There's a few more out there now. And then I would say last, there's a lot of folks just buying, great existing businesses, and they may partner with their, former best employee to go find one locally in their area. Or I've also seen, as there's more different types of investors into this category, some focusing on really niche areas. So I've met folks that all they are doing is trying to buy, 2 to 3 small niche e-commerce businesses, which probably don't, hit all the buttons of classic search, but, hit a lot of the same kind of entrepreneurship through acquisition concepts. So that's been kind of my approach over time. And I've just really enjoyed being out in the community. I've probably talked to, 200 plus searchers, investors, third-party advisory folks. The neat part about it is, as I mentioned, a really collaborative community that really, I think, has the ethos of startups, where it's really about backing great entrepreneurs, which I love. So that it's got that feeling, which I love. And then it's got a feeling of kind of great value investing for folks that, disciples of Graham and Buffett and Constellation and the outsiders. It's got a nice mix of both. So it's a really neat community. And I think there's, as Karen showed in her slides, it's really grown exponentially the last decade, where, went from 1 to 2 to 10 searchers to, like what I think she said, 80 deals done last year. And so that's been my evolution in my search investing journey. And, I think it has a lot of, similarities to investing in, venture capital angels, except the difference is, as John said, probably a better risk adjusted return. But you get a lot of getting to work with great high caliber talent, making an impact on the community and growth in small businesses. And it's been great so far. So I'm happy to answer any questions folks have of, differences from being kind of an angel investor to search fund investor, or doing startups, et cetera. But that's a little bit of my story and journey. And thanks, Carl, for the invite.
All right. I'm just checking the questions. There's been a lot of, thank you very much, Karen Spencer. You've jumped right on that. Any questions for Steve specifically?
Yeah, I got one. I don't know if I'm interpreting it correctly, but do you support the concept of the circular economy, which I don't know exactly what that means, but my assumption it means is, hey, when you've had success as an entrepreneur, to kind of pay it back forward and invest in the next generation of entrepreneurs.
May I answer the question?
Yeah.
Circular economy is a fairly new concept. I believe it originated from Europe, probably Denmark, UK, and so on, which means instead of developing everything on a linear way that we ended up in the mess right now with the environment, circular means that everything basically is based on recycling, reuse, and reduce, recycle. So basically reuse things so we're not going to waste that much and so on. That's what circular economy is.
Yeah. Oh, cool. No. Yeah,
Thank you.
Obviously that resonates with me, and as someone who has, young kids and trying to pass on the world a little bit better, resonates. And you could argue the same with entrepreneurship through acquisition is doing that, right? So, people have built these great enduring businesses. It would really be a shame for them to go away, right? So they, to your point, I don't know if searchers would like to call it being reused, but a lot of that concept of if someone's built a great asset, created jobs for a number of great folks, created great services that helped their customers. It's part of the passing on the legacy is the circular economy of taking these great businesses and keeping them going. I also think they're like key suppliers. So I've done a lot of government work, my background, and so there's also on these items, you're doing key suppliers to the government are actually, serving a great function, whether it's, I've looked at companies, doing helicopter maintenance for the military and items like that. So the circular economy is also kind of doing good by backing, continuing these suppliers to important items.
I think when I joined Angel One, they talked, the mission statement of Angel One is to build the building the Canadian economy, or we could say maybe now rebuilding the Canadian economy one deal at a time.
Yep.
And it struck me that we were very, very heavily focused in startup community, finding the next Shopify. However, what I see is hundreds, if not thousands, of lower middle market quality Canadian companies that are the backbone of employment and economic welfare for many, many Canadians across Canada, that are as much as critical to the future of rebuilding this economy. And innovation isn't limited to only the next startup, but if you hear about the value creation that's happening within the lower middle market by newly minted, CEOs of these businesses, they are bringing best practices and innovation to these businesses, and often creating competitive advantages in businesses that where the previous owner maybe was at the horizon of their career and either wasn't willing to take the risk or make the investment in technology and all the sorts of best practices and innovative approaches that these newly minted CEOs bring to the table to see the kind of value creation. I think it's something like 1.7 trillion of Canada's GDP is in lower middle market businesses, privately owned companies with baby boomers seeking to retire. So I think it's a massive opportunity.
And Carl, let me add something to that about one of the just absolutely wonderful benefits of this space. Those of us who knew the lower middle market before search funds would and people, owners on the line know this, that it is not easy to sell a lower middle market business in Canada at any time. And it's probably similar in the US. I mean, there just simply are not a lot of buyers. And the problem has become over the years that the buyers tend to be, they know that, and so they become value buyers. So they tend to say, well, you don't really got another choice other than me, and I'm only going to give you minimal amounts. I mean, in the old days, we used to hear people talk about book value. All I'm paying for is your assets, none of the goodwill you create, it's just crazy. You felt bad for an owner who, sweat and blood built something special and then comes to the marketplace and basically is held hostage because, there was no buyers. I mean, the private capital in Canada is so upstream with pension funds and larger deals and global, that's the sad part of our marketplace, right? Public money is focused, public pension funds are focused on upstream deals. And all I'd say is what the search funds have done is really given a ton of respect to owner operators and giving them a chance to exit at good values, that are reasonable, that are fair, that are way more appreciative of the true value of the business. I can't whatever the right word is, I can't emphasize that enough of one of the great, whatever you want to call it, unintended consequences of the space is it has forced up valuations for lower middle market companies in a way that helps every owner operator. The more search funds we have, the more self-funded folks we have, the more owners and businesses are going to be respected.
Yeah. And I would add on to that, Mario, too. As someone who left a comfortable government job to go into entrepreneurship, I meet a lot of folks that are in kind of safe corporate or government jobs that have kind of this entrepreneurship bug they want to itch, and they just don't have the idea or the kind of, we talked about the risk-adjusted return for an investor. There's also, it's a great risk-adjusted return for the entrepreneur, right? And I've seen so many searchers light up when they've changed their life, and they've basically gotten that baton from the founder. So the founder is excited to pass on their legacy, and then the searcher is kind of bringing out a part of themselves they never knew and have always wanted to do. And that's to your point, Mario, selling at the lower middle market, from some kind of low end PE shop that's kind of doing a value buy is very different than passing on like a legacy to a 35-year-old Ivy Business School grad who's, maybe, in government or large company and is like fired up to take that like awesome niche Canadian business forward. So I think that's great. I'd also say anyone on the line, I think there was one comment of, hey, I'm potentially interested in this as an owner of selling to this group. I'd say if that is an interest, I think generally all the kind of great groups and search funds and people in the ecosystem, anyone on this call would love to connect you with searchers. I'd say there's always kind of that marketplace of, searchers are trying to find great businesses and business owners are trying to find, good buyers. And, there's great intermediaries like Carl that do that. And there's other times that the business is too small to have an intermediary. So just, if you're interested in that, pass it on. Or if you're friends at a country club or you're, you coach on the hockey league with, who might be a fit, just send any folks to anyone in this group. So I just think that it's a great way to pass the torch.
Perfect. Thank you.
Thank you very much, Steve, for your perspective. Karen?
Thank you, Steve. Yes, no, absolutely. And so I'd like to move on, Dan, to you, our last speaker / expert in this incredible panel. No pressure, no performance pressure there, Dan. But I have a sneaky suspicion you can handle it. So I think you've got your camera on. Yes, there you are. And over to you.
Great. Thank you, Karen. Thank you, Carl, for hosting this great event and for having me. I'll get into my bio and that of my business partner later, because I'm going to spend a few minutes telling you guys our case study, like our story of how we found Search, the business we bought, what happened, and what we're doing now. So if you don't mind, we'll skip to the first or the cover page of our deck. Yeah. So what we did is we chose Canada because we were living in the US, and we tailored our search for the Canadian marketplace. And so we did things a little bit differently than the way your usual search fund will approach things. And I'm going to tell you guys our story of how we chose those things, why we structured it the way we did, and how that impacted our search effort. But I'll try to contrast with the traditional model as much as I can throughout. And so if you don't mind skipping to the first page, I'll introduce Leroy and I. So the first thing you need to know is we're buddies from high school. We played basketball together, never made it past high school. So that was kind of our first disappointment in terms of career prospects. But we ended up going to McGill. He studied finance, I studied engineering, and we ended up doing a class project together in a class called Management of New Enterprises. And that's when the spark kind of lit up. And we stayed in really close touch post undergrad. We followed fairly traditional career paths, and this is not necessarily all searchers have this kind of background, but a lot of them do. So I'll spend a few minutes just describing the roles we had post undergrad. So Leroy joined the restructuring and special situations group at Lazare et Frères in Toronto, which is a boutique investment bank, and worked on cross-border transactions with large US sponsors. Of note, he worked on the Hudson's Bay takeover opportunity in 2005. And then ended up joining Oaktree Capital's control group. So Oaktree is one of the largest distressed debt investors, and they have a control group that basically is designed to take over businesses through leverage buyouts, but also looking at distressed debt at a discount and then eventually owning the business through restructuring. So he was there from 2006 to 2010, lived through the crisis, and really got some foundational training in investing from some of the best distressed debt investors around. During that time, I wasn't too far away. So Leroy was in LA and I was in San Francisco. But before joining him on the West Coast, I worked at McKinsey & Company, did a lot of traditional strategy type work, but then eventually landed in a few private equity due diligence mandates, which McKinsey was doing a lot of at the time. And that's how I discovered private equity. I decided to join a lower mid-market fund to learn what it would mean to buy a smaller business. And And that's kind of what led to a lot of the early blueprints for Snowden. Is mostly on weekends we'd get together and commiserate about all the limitations of working private equity, and built a blueprint. So long story short, Leroy ended up going to Harvard Business School, and he took Rick and Royce's class, who are the two professors who teach in entrepreneurship through acquisition class. And the more we talked about it, the more we built conviction that we should come back to Canada and raise a fund. I should note that we also had a few friends who had done searches. So Mario was making reference to Rob Charon of UCIT, which was one of the first Canadian search funds. I actually reviewed his PPM when he was at Stanford. And so we kind of knew about the space and built conviction around it, but we wanted to tweak things a little bit. So we ended up raising an all Canadian investor base. To our knowledge, we're the first kind of formal traditional search fund that did that with all Canadian investors. And we ended up buying a B2C tour operator. So we send Canadians abroad all over the world. And it had repeat but not recurring revenue, which tends to be a pretty important component for any search-based business. We spent 5 years building that company, and I'll tell you guys a little bit more about that story. But basically, we completed an add-on acquisition, launched a new brand, tripled revenue, and we completed a recap about a year ago, right before, kind of, we call it the buzzer beater recap, but right before all hell broke loose from a COVID standpoint. So that was really good timing and fortuitous, but basically it gave us an opportunity to return capital to investors, and have been investing in search funds like many searchers do for the past year. So we've backed 13 funds in the last 12 months. We have funded 3 deals since September, and our target is to do about 10 or 12 searches per year. And the goal in the long run is to have 15 to 20 companies. So we're building a small portfolio of search-backed companies, and I'll take you guys through that. So that's kind of our story. If we can flip to the next page, I'll tell you a little bit about how we went about it and why we did it. So we basically really were adamant about having a 100% Canadian investor base for 3 primary reasons. The first is, like any entrepreneur, we took a supply and demand look at the search ecosystem, and everybody was searching in the US. There were very few people searching in Canada. So we said, hey, we should probably search in Canada. And as Mario pointed out, search funds don't always have the best reputation in terms of the mid-market advisors. And so we went about our search in a slightly different way, in that we focused a lot of our time in Quebec, where we're from. We understood that most businesses in Canada don't meet the criteria of a traditional search fund target, meaning highly recurring revenue, contracted, B2B, that kind of thing. And we also just had a bias for working with owners who were motivated sellers who had already engaged an advisor. So we deprioritized the search, the proprietary search piece of it, focused more on intermediary deal flow. And we had to broaden the scope of the types of businesses we would get involved with, because we felt like if we did things the way the US searchers typically did, we'd run out of companies pretty quickly in Canada. So we wanted investors who were open to that approach, and that's what we aligned with. So the second thing we did is we aligned with highly recognizable investors, which helped open up some doors. So we were pretty pleased with the group that we were able to put together. We had the founder of Aldo Shoes, Aldo Bensadoun, the president of Technion, which builds the furniture for a lot of leading companies, including the Apple headquarters. We had people who are on the board of National Bank, which is the largest bank by market share in Quebec. In our investor group, with the founder and inventor of the Diaper Genie. For anybody who has grandkids or kids, you know that product. He's a Montreal-based entrepreneur, very well respected. We had the former president of the Caisse de Dépôt, and we had the former Canadian ambassador to China. We didn't know if and when that would be helpful, but it's kind of nice to have a mosaic of very different people who have different experience sets, but all of whom are recognizable here in Canada and give you instant credibility when you meet a seller or a lender or whoever else. And the third reason that we did this was quite selfish, is there's this notion of Canadian control when you're doing deals and maintaining CCPC status. And Mario and his team were advising folks and said, well, it's not airtight. It depends on where the mind and management is and what the percentage ownership is and all this kind of stuff. And we said, okay, well, if we have 100% investors that are Canadian and we control the GP, then we're basically guaranteed to have Canadian controlled private corporation status. And what that allows us to do is multiply the capital gains exemption and improve our carry economics. So that was a very attractive reason to do it this way. I've then kind of shown you a snapshot of the actual budget that we put forth. So we ended up raising $550,000. Unlike the US model, we did everything with a Canadian LP. So all the investors came into a Canadian limited partnership, and we didn't put a unit size. It was basically $1 increments, and we guided people to say, take as much of this as you want based on your expected equity deployment check. So if you're hoping to deploy $500,000, you should not be putting $100,000 into our search. If your hope is to do at least $2 million, then you should probably put in more of the search, but we were quite flexible in terms of dollar amounts and whatnot. As you can see, most of the money goes to paying the principal salaries, and the goal is to run a very structured, thorough, diligent search for a business. And then we had accessory expenses like, a small office space that we shared, and a variety of other things like travel and things of that nature. So we can skip ahead to the next slide. I kind of went back to our CRM and looked at, how many actionable deals we did. We looked at. So we had about 200 deals that we were actionable. The mix was, what you would expect, about a third business services, a third manufacturing, and then distribution, software, a variety of other things. We conducted 38 management meetings. So of these, it was about 17.5% of the deals that we saw were worthy of a 1 hour or 2 hour sit down with management. And most of the businesses we looked at were within driving range. So we just get in a car and go meet face to face. And that has quite a meaningful impact in terms of getting to read the seller, and understanding if there's a deal to be had there. We ended up submitting 14 non-binding offers called expressions of interest or indications of interest. We submitted 3 LOIs. We lost one of them to another buyer. 2 of them were accepted. One of which we aborted 30 days into our commercial due diligence. Thankfully, we hadn't turned on the third-party advisors. And we ended up closing one deal, which was basically month 17 of the search. It's right at the average. I think the median is 18 or 19 months to close a deal from the time you kick off your search. So that's why people tend to raise at least 2 years of runway. But basically, our volume, if you compare it to a proprietary searcher, is quite small. A lot of proprietary searchers would blast thousands of companies. We had a much more kind of controlled funnel because most of these were already represented by sell-side advisors, and we knew they were for sale. So that's kind of our story. I'll talk about the deal now, and it's hard to compress 5 years onto one slide, but if we can go to the next slide. We bought a company in Quebec City called Incursion Voyage. It's a French group tour operator. So we send Canadians abroad all over the world on escorted group tours. Think of like a 2-week Italy trip or a South Africa journey, where we will have guides, step-on guides, experts that come in and basically show you around the country, all the meals, the transfers, the gratuities, everything is included. And that base business, like much of the rest of the industry, had run in a very traditional way. So they used print, radio, and if you can believe it, the French version of CBC for television advertising as a means of acquiring customers. And we took some pretty meaningful steps to transform the business. So the first thing is we abandoned all traditional media, and we basically shifted everything over to digital marketing in 2016. I suspect most of the businesses today already have, embarked on that digital transformation. We also replaced most of the team with much higher caliber talent, and expanded gross margins quite significantly. So through this process, we met a bunch of our competitors, understood what their margin structure were, realized that a lot of people were anchoring to the wrong framework mentally for how to price. And so by expanding gross margins, we were able to get lift on EBITDA pretty meaningfully. The second thing we did is we acquired an English, highly respected, one of the best brands out there for escorted tours called Journeys by Van Dyke. It's a company in Cambridge, Ontario. And it was a highly accretive acquisition. We applied all the things we had learned in the first 2 years of running Incursion, exploited some pretty meaningful procurement synergies, and basically achieved a 6-month payback on investment on that deal. So the first year we had already hit 2 times money, which was quite attractive as a business. And then we weren't done yet because Journeys tends to serve very high-end tours. So to give you guys a sense, Incursion was about a $5,000 to $6,000 price point. Journeys is a $10,000 to $25,000 price point, and we saw an opportunity to do something 4 stars in English for the rest of Canada. And so we launched Approach, which is a de novo brand. It was really cool because we got to build a startup within the ecosystem of a 40-year-old company. It took about $500,000 of investment, just mostly on marketing and things of that nature. And we took it from 0 to $4 million in the first 12 months. So all those things happen. And then you get to 2019, you hear all these headlines about how a recession was looming, it's around the corner, or this and that. And so we decided the timing was opportune to build a recap and a mechanism for people to get capital out. And so we returned capital basically, like I said, about a year ago. It generated a great return for investors. So Incursion, when we bought it, was a 100% equity deal. We didn't use leverage. We had a 5 times cash on cash exit for our investors on an unlevered basis. That's quite attractive return profile. And the main goal for us coming into this was let's make some money for a dozen or so high net worth guys, and who knows where that will lead. And so in many respects, it was kind of mission accomplished. If we can go to the next slide, I'll tell you guys a little bit about, like many other former searchers and former operators, we have begun backing searchers. We are new to the investing world. There are a ton of really successful, like the reference within the search fund ecosystem. They're colloquially called the search fund mafia, but they're a group of people who've seen every single deal, invested in some of the biggest success stories. And so we're sort of trying to play catch up a little bit, but everybody who's been really successful here is mostly indexed. And we're doing things quite differently. We're not indexing. The model has exploded in the last decade or so. And so to give you guys a sense, when Leroy was graduating out of Harvard in 2012, there were 3 search funds formed out of HBS that year. Last year, there were 35. And so you get a massive influx of searchers, and the model has expanded from, what was once mostly a club of, Stanford, Harvard, INSEAD, and maybe Wharton, into a much broader acceptance within some of the top 10 MBA programs and non-MBA candidates. And as a result of that, it's become really difficult to figure out where should you invest. And so there's 2 kind of approaches. You can either spray search capital across many, many different searchers, or you can be quite selective, and we've chosen the latter. And so we have a bias for people with prior transactional experience. And I'm happy to take that conversation offline and explain why we believe in that. But long story short is we have backed 13 search funds out of 100 pitches. 4 are graduating from Harvard Business School, 2 have come out of Berkeley, 2 out of LBS, and only 1 out of Stanford. Getting into Stanford-backed search funds is extremely difficult. It's highly competitive, and we've only been able to get into 1. So we're still chipping away at that program because they've got really outstanding searchers. And so my message to you guys is, it takes a lot of work. You got to be really involved in each of these schools and understand who the top caliber searchers are if you're trying to cherry pick. And it's even for us who've been in the ecosystem for 8 years, it's still really hard to get into the cap tables. Our goal is to do somewhere between 25 and 30 searches over the next couple of years. So we're allocating $1 million USD to that. Why USDs? Because they tend to raise in US dollars, and 30 to 40K slugs for search capital. And then we're going to gain diversification by deploying into portfolio companies. So we've done 3 deals to date. Our average investment is 400K US. And our desired portfolio size is somewhere between 15 and 20. So if you take the low end of that, 15 out of 25 is about 60%, close rate. If you take the higher end of that, 20 companies out of 30 is about a 65% close rate. So much to John's points earlier about the close rates, we agree. I think it has come down, but our average investment would be somewhere between $300,000 and $1 million per deal. And that's kind of how we're approaching our search activities. The last thing I'll say is that we're not an institutional investor. There are many of those, like Sage and others. Our role on the cap table is as a former searcher. So one of the searchers kind of gave us a nice framework, which I want to leave you with. There are old hats, there are gray-haired guys, and then there's like older brothers. And the old hats are the guys who are, have been around forever, have been invested since the 80s. There's the gray-haired guys who are the really experienced investors, and you go to them for advice and strategic guidance. And then you have the older brother who you can turn to with whatever is your embarrassing question or issue that you don't want to go to the gray-haired guys with. That's kind of the role we fill. So we're on a text message exchange basis with our investors. We're super accessible. and no question is off limits for us. So that's the role we fill in the cap table, and that's the segment of the cap table that's growing fastest is former searchers who are now kind of paying it forward, as everybody discussed. So I'd love to leave as much time as possible for the panel and Q&A. So I'll just kind of stop here, and happy to connect with anybody who'd like to offline about search or anything like that. Happy to contribute in any way we can.
Sorry, here I am babbling and saying how fantastic that was, and you can't hear me.
Dan, that was really a great story, and thank you for sharing all the detail in your journey. I really like the detail because I'm sure investors are asking, what's the 500-600 for? The fact that you tell us that here's what your rent's going to be. It's love that detail.
And that's quite common, right, Carl? Like in the PPM that Mario was referring to, you'll have the detailed budget that the searcher plans on how they plan to spend the funds during their search.
Yep.
Just to give people a flavor.
Great.
Okay, we have a large crowd with us. We've been 55, 57 folks on this call, which is great. Thank you so much for everybody staying with us. So I'm just trying to get, Carl, do you have any questions that you want to, any threads there that you want to pull on to ask the panel? I'm just trying to catch up because I was riveted with what Dan was saying.
Are there any cautionary tales that our investors should be aware of as they start to think about this and allocating within their portfolio to this asset class? Some of them I think kind of were touched on in your individual presentations. Is there some, Steve or Dan or Mario or John, Karen?
So I think, if I'll jump in first, I think there's a few key points. I think the risk on the initial $50,000 investment is probably, I would say history shows the highest risk. And so I think John said it well. There is up to a third of searchers who don't find a deal. It does happen. No matter how hard they try, sometimes it's luck. And so that's probably the greatest risk on that front. I think when it comes to the deal itself, as the space begins to expand, we are starting to see, I would say, particularly on the self-funded model, more searchers doing deals that I would traditionally say to you as a private equity lawyer don't look like private equity deals. And so, private equity and the search fund space in this sense are very similar, right? We focus on low CapEx, recurring revenue, a decent growth story. It doesn't have to be 20%. This isn't tech, 5 to 10. I mean, no retail, no oil and gas. I mean, this is, tends to be distributions, business services, SaaS service. There's a model to this. If you look at the success stories, they tend to be businesses that follow the model. If you are investing in this space and you're not investing in that, you're kind of on your own, right? You're outside the model, right? As my fellow panelists will tell you, the deals in this space kind of look very similar across the board. Yeah, they have certain differences, but this is not a venture play. This is not a retail play. This is not a, I'm investing in a research and development play. These businesses already have traction. They've already proven themselves, and you should stick to the model. And if you don't, you're on your own. Like it's outside the model, and it doesn't play well to the model strengths.
Mario, if I can add on to that, a lot of people view the search fund model as backing jockeys as opposed to picking horses.
Yeah.
And so what you're describing is, look, the businesses that these people are buying are usually quite unsexy. They've been undermanaged. And the magic that happens is when you find a great jockey and turn them loose inside one of these businesses, that's where the creativity gets deployed and the buy then build. And so the corollary to what you're describing is, as the model explodes, it is quite attractive from a searcher perspective, right? Like the notion that somebody else is going to pay your bills to go find a business and then give you the money to buy a business is quite an attractive value prop, and it's compelling. And as we look at the Stanford Search Fund study, it is a rear-looking, like reverse-looking study, and it's cumulative. And so that does not necessarily mean that that's what the kind of return expectations are going to be when there's 5 times, 10 times as many searchers out there. And so be thoughtful about who you're backing and what kind of businesses they're buying as well. The two of those ingredients make up the salad here.
Yeah, I would add on to Dan like that. It's actually kind of like angel investing in startups, right? You really, it's the best or a lot better. And I think there are a lot of folks, I think on the searcher side that think, they go to HBS or a top business school now, and they're like, this is the best risk adjusted return to make $5 to $10 million bucks. And as Dan and others, any entrepreneur knows, if you go in it, is that the only reason why? Like business is tough, right? You want folks that are doing it because they want to do it. They can grind out the cold calling and they can handle tough employee conversations. So I think finding searchers that are in it for the right reasons. And the same way with investors, I think there's some folks that, as Dan said, chasing a kind of a PDF return model, which I think is backwards looking, and you should want to do it partly because the reason you like it backing entrepreneurs. So I think it is a good risk adjusted return, but with so much variation in the model, it's also not one just to kind of dump money's sake. So I think what's special about the model is because it's been very close knit community that has a focus on people doing it for the right reasons and great mentors for the right reasons. So, and then my last, which is if you put your toe in, this is just like angel investing. Always ask, why am I seeing this deal? And so I think in angel investing, the first time I started doing it and started seeing deals, you like seeing deals, right? And as a newbie on angel investing on startups, right? If you're seeing a deal, there's probably a reason why. And the same way in search. So I think classic, spend 3 to 6 months getting active, saying no to stuff, just kind of warming up. Because like any good asset class, real estate, right? If you kind of get into new alternatives, understand what a good deal looks like, who are good people to associate with. And like I said, always the easiest thing for any new asset class, I don't buy real estate direct. I'm LP in the kind of some niche funds. I think always any alternatives, like being an LP is a good way to start, or at least talk to a few of those before kind of doing your own kind of stuff.
Steve, I just wanted to add a couple of things to what you said. That mentorship is such a key aspect of the space. Everybody on this email gives a considerable amount of time that isn't associated with a quote unquote personal return. I mean, the amount of time that all of us volunteer to help people who want to start out on this journey is part of the commitment to the space. And I cannot underestimate how important that is. And, we kind of often look for, people who say to me, Mario, suggest investors. I look for investors who get that aspect of it. And so we're always looking for people who can add more than just the dollar amount to a deal. Because we're all in it together, right? We all want to see the space succeed. And so obviously good quality people look for good quality people. And so I can't underestimate that. And the other thing I would say is, the profile of success of search funds, well, first of all, the hold periods tend to be longer than private equity. They tend to be kind of 4 to 7 or 4 to 8 years. And there's a reason for that, because particularly the history in Canada has been that organic growth drives the success more than acquisition. And if you think about it, you need time to ramp up capacity in organic growth. And so, it is not unusual in search fund deals to kind of see them almost flat for a while, and then they just kind of take off. But they haven't really been flat because they've been doing a lot of the hard work behind the scenes to kind of clean up the supply lines, start to build capacity on the sales front. And it takes a few years. And so this space could be a space from a stomach point of view where you just kind of, you got to be patient. You got to let Dan will say, you got to let the CEO do their work and the board. And so if you're expecting to kind of see, you know, it's just not that kind of space. Sometimes certain changes take a few years to implement and then it takes off. And that's, you know, I've seen search fund deals where nothing happens for 3-4 years and then all of a sudden you just jump, you know, so you got to be ready for that as an investor.
I noticed what attracted me to this space is when you sit with the angels and you angel investing and you learn about how to do that appropriately. The first condition is always, you know, you're betting on a founder. And I found that very similar to this space. You're still betting on a founder. However, in this space, as John pointed out, you're also, the interview process, if you will, with the founder can be up to 2 years. He or she may not be aware that they're being interviewed for 2 years, and you've taken an option. And I think that helps the success overall, because I imagine, as we said, the biggest risk is that they don't find a deal, and they, you know, but the investor hasn't gone all in yet with that particular entrepreneur yet. And I thought that was very intriguing to me about it's similar. You're betting on a founder. But when I look at startup decks, it's eight slides, 1 slide on the founder, 20 minutes, maybe a deep dive that's 3 hours, and you're supposed to invest.
Yeah, and Carl, if I could jump in on that too.
Yeah.
You know, I think it's not only are you're betting on a founder and you get that 2 year, up to 2 year interview process, but it's also, you know, you're betting on a founder that's going to go in there, but the actual founder of the company continues to be involved, and so you get the benefit, or your searcher gets the benefit, and we as investors get the benefit of a transition plan. And you know, certainly there are cases, as Mario mentioned, where, you know, on day one you'll go in and the founder just wants to exit, and you can jump into situations like that. But I would say certainly that's an exception. Usually what happens is there's a transition period of anywhere between 3 months to, in some cases, many years, where the founder of the company is sticking around. He's, you know, typically incentivized to work with the searcher coming in to ensure a smooth transition, because he has earnouts, or he's got vendor take-back notes, and he's got other contingent consideration that he's waiting to receive from the transaction. And so you get this situation where, you know, you get the young entrepreneur going in, and you've worked with them for 18 months or 2 years. You're feeling pretty good about their prospects of being a CEO. And then you go into the business and they start to run the business. And instead of having all of those hiccups that, you know, typically startups would have, where, you know, if you take an example of a founder who's, you know, really at heart a scientist, and they go in and they've come up with a brilliant idea, they've gone and gotten patents on the technology that they put together, they start a business, but they maybe don't know a ton about running the business. They're going to have a bunch of hiccups along the way, and they're going to stumble, and they're going to, you know, try to find the right path forward to running their business. And some will be successful, some won't. I think the thing in search is, as the searcher is kind of stumbling around finding his way to run that company, he's got a board of directors that are very, very much hands-on and help, you know, in both the operations and strategic side of the business. But then he's also got the founder there to say, hey, I already tried that last year, and this is what I found, or, you know, we've explored this option, and this is what we found when we were exploring it. And so it's a great system for a young entrepreneur to jump into and have a lot of support along the way that they don't typically have in startups.
Yeah. No, it's got all the elements that are required in a good quality startup baked in as part of its strategic architecture, I would say.
Right.
Very, very good. Have we got any other questions from anyone else in the audience? Or
Well,
can't believe we answered everything.
Yeah. wanted to add on just to, I think what everyone else has said, and I do hear a lot from searchers, from new investors coming in, particularly folks who have worked in private equity and other spaces, about the unique culture of the search fund ecosystem. As everybody has mentioned, it really started from a collaborative, mentor, supportive environment, and that has still held through even with the tremendous growth of search funds. So once somebody becomes an operator, they don't have that same kind of competition factor with other operators. They tend to form groups and share and really try to lift each other up. And that really makes it for an enjoyable experience all around.
Well, and I just want to wade in and say what's interesting for me. I've spent an awful lot of time with extremely early stage companies, and you've got the leadership, which is untried. It's their first time round, and then you've also got the worker bees, the managers, the company. In a startup, you've got so many people that are wearing so many hats because they just don't have the resources to cover the waterfront. What I find extraordinary about this idea is that you've got a well-oiled machine, maybe not working at top capacity, but it's still functional. So you've got a company that's obviously working well to some degree, and the opportunity for the searcher that comes in, the operator, is to crank that up, get the flywheel really going, versus trying to teach everybody how to do their job and learning all the stuff that they've never done before. So, I mean, the positioning between these two scenarios is quite stark in my mind. So that's the thing that I find really interesting about the concept of search funds and that whole investment model and the profile that they present versus the very early stage environment that our members we've got lots of our equation members on this call, and I'm sure they're having somewhat the same thoughts. So this is very, very interesting, folks. And I can't thank you enough for this huge investment of your time. It's been very useful. We'll be going through the chat, and if there are any questions that weren't answered, we'll either move the questions on and ask for you to respond to these folks. Last chance, everybody. We've got, I want to wrap this up by noon. So we've got 2 more minutes, or any other comments that any of the other speakers want to make, that would be very welcome.
Thanks for putting on the event, Karen, Carl. Great event, and lots of great resources as put from Search Funder to others. So encourage folks to read up, and at least myself, I'm sure everyone else, happy to help if I can. So you can stalk me on LinkedIn or one of those and find my info.
Okay. We're good stalkers, Steve. I'll just warn you.
Agree with Steve. Feel free to reach out to any of us. I mean, that's what makes the space unique. You'll find people incredibly helpful, and probably the first place to start is Search Funder, and Karen and the team do some pretty amazing stuff there, and it's just a huge resource. And it really has, at least from a Canadian perspective, been just hugely beneficial for the growth of the Canadian community. So I would say to everybody, if you want to know more, start at Search Funder. And Karen doesn't pay me to say that, for the record. There is no money that comes from Karen. I probably should be paying her instead of so.
Well, this was an introductory session, and again, I think you all did a spectacular job and really laid the base for us, and probably got us thinking a lot more than we anticipated. Carl and I have talked about, if there's interest, we would consider putting together a more in-depth workshop that, and again, we'll communicate with the speakers that participated in today and just see where it makes sense. And I think I want to thank Michelle McCorkle, who has been the puppet master in the back, who is our never failing support system of everything that we do. My partner in crime here, Carl Cedrust, who came up with this idea, that has been watching search funds for a lot longer than I even knew about them. So it's great having all these great new ideas brought to us. And again, to all of our speakers that participated today, I can't thank you enough. This was really great. It's 12 noon. We're going to call it quits. Everybody have a great lunch, and thank you so much again for your time.
Great. Thank you, everybody. Take care.
You.